Morning.
Senator Jennings, would you please come to order?
Oh, I didn't see you. Did you come in?
Good morning, Senator. Good morning, Senator. Thank you for giving me a little extra time. I'm sorry that I'm late. We'll work hard to start these meetings on time because I know that you all are have other things to do, but making sure that we're finishing our work on the on Capitol today is also incredibly important. So thank you for giving me a little extra time. I want to address something right away before I go to getting the roll call done and officially getting the meeting underway. We are going to have an audio recording of the meeting. We're having trouble with the camera. I'm going to boss our good friend Steve. I want you guys up here the day before with a trial run with the meeting. This is the second time, for whatever reason, we can't seem to have the webcam work. And whatever you need to do to make it work will be done unequivocally by the next meeting. Or we won't, or we'll find a new location. Whatever the problem is, must be resolved. Yes?
Yes.
Because that was supposed to be resolved today, and that's our second meeting, and it is not resolved. So I just want to make sure that folks know what's occurring and that we don't know why the camera doesn't seem to be working. All right, so with that, let's go to the roll call.
Sure.
Good morning.
Good morning. Governor Lujan Grisham.
Here.
Peter Frank.
Here.
Secretary Padilla Jackson.
Here.
Linda Eitzen.
Here.
Tim Jennings.
Here early and on time.
Thank you. Harold Lavender.
Here.
Treasurer Eichenberg. Commissioner Garcia Richard.
Here.
Lee Rawson.
Present.
Scott Smart.
Here.
Lynn Hoffman. I did hear Lynn.
I did, and since we're doing an audio, let's make sure Lynn is present, and she's joining the meeting via telephone.
You do have a quorum?
Thank you very much. All right, shall we go to, we didn't introduce, and since people can't see us, why don't we do quick introductions now that we've got a quorum, and we'll start at the end of the table.
Carrie Siegel, SIC Office.
Matthias Bauer, RVK.
Marsha Beard, RVK.
Charles Molman, SIC office.
Brent Ship, SIC office.
Ben Bland, same.
Ben Smith, the SIC office.
Steve Moise.
Peter Frank.
Governor Michelle Lujan Grisham.
Olivia Padilla Jackson, DFA Cabinet Secretary.
Linda Eitzen.
Lee Rawson.
Stephanie Garcia Richard, Commissioner of Public Lands.
Harold Lavender.
Scott Smart.
Tim Eichenberg.
Tim Jennings.
Let's do the, no, we didn't do that last time, but we're going to do it this time.
Chris Harris, Brookfield Asset Management.
I'm Ben Vaughn from Brookfield Asset Management.
Nino Carpenter, SIC.
Bruce Brown, SIC.
Starla Bennett, SIC.
Clay Camper, SIC.
Seth Marcus, Townsend Group.
Jack Oak, the Townsend Group.
Justin Green, Entrepreneur.
Eric Dyson, Citizen.
Jennifer Wildman, Axia.
Brian Goldberg, Axia.
Janelle Booth, RVK.
Kenneth Segurano, Global Business Partners, and InvestNewMexico.us.
Art Stuckey, SIC staff.
David Lee, SIC staff. Chris Cassidy, staff.
Richard Pugmark, Pavilion Alternatives Group.
Ashu Agrawal, DA Associates.
Alan Walter, Pavilion Alternatives Group.
Paul Chapman, SIC staff.
All right, thank you, everyone. All right, let's approve the agenda. Do I have an motion to approve the agenda? Harold. Okay, I've got a second. All those, any discussion? All those in favor, say aye.
Aye.
Any opposed? Anyone abstaining? Motion carries. All right, do I have a motion to approve the minutes of January 22nd?
So moved.
All right, got a second and a move. Thank you very much. Olivia, is there any discussion? Seeing none, call for a vote. All those in favor?
Aye.
Any opposed? Any abstain? Motion carries. All right, we are on item 2 of the agenda. So we've got the State Investment Officer and Chief Investment Officer briefings. So I'm going to go to Steve Moise first and Vince Smith. We can, in a fluid fashion, go through this item.
Fluid and rapid.
We love rapid, as long as we get all the information that we require.
Thank you, Governor. Over the last 12 months, distributions to the state from the funds have totaled $945,299,000. Price of West Texas Intermediate as of yesterday, was $55.39. And our net asset value as of the end of the day yesterday, $24,390,605,000. Approaching our all-time high water mark. Looking at the SIO report document that you have in your materials, we're not going to cover in depth the items under A, which are three things the governor asked us to focus on. Educational initiatives, which we have pursued over the years and which we continue to. How we invest in New Mexico, and investment management fees. You have detailed materials on each of those topics in your books. I'm happy to respond to any questions or try to give you more detail if you wish.
May I interrupt you? Do you want to just maybe give a highlight for each of those categories, even though it's in the binders, just so that the folks who didn't get this entire binder?
I'd be happy to do that,
That'd be
Governor.
great. Any objection to that request? Thank you.
In the materials is a memo that I sent to each of you called Focus Topics. So under educational initiatives, you've each received a copy of our 60th anniversary report. I listed for you the places where we have spoken publicly about the funds, just to give you an idea of what Charlie and I try to do each year to go around the state and better inform our citizens about the permanent funds. And then we also mention the enhancements that we've made to our website. Those are self-evident, and Carrie and Charlie are constantly trying to improve the website. We try to brief freshman legislators every year, but we aren't always invited. And we ask to be invited. It's difficult because we're usually given only about 5 minutes. And they try to squeeze in as much substance as they can. And hopefully in years to come, the council will be invited each year. We attend editorial board meetings around the state and have had reasonable response from most editorial boards, some of which are interested in the permanent funds and some of which are not. We'll continue working with these people. Some have been very interested and very responsive. Then I've listed for you 5 things that explain how we invest in New Mexico. With our New Mexico Private Equity Program, our co-investment funds, the Catalyst Fund, the Small Business Investment Corporation, SBIC program, and other investments that we make in our national private equity, real estate, and real return funds. And finally, 2 presentations on investment management fees, which Vince put together, which I think tell the story in detail and well, and I commend those to you. Other topics we will cover today include legislative matters, which Charlie will cover at the end of the meeting. And Governor, I think that is all I have for you.
All right. Do we have any questions of Steve on his part of the presentation? Okay. Thank you very much, Steve. So you want to do performance reports?
Vince.
Thank you, Governor. This is the month where we have all of our private asset reports also, so extensive reporting on performance we've got for you today. The consultants will walk you through those reports as they normally do. I'd like to take just a few minutes and put some context around those reports, around that investment performance, just to get a better understanding of why those numbers are the way they are and how they got to be that way, and sort of what we expect going forward a little bit. For almost a year now, we've been talking to you about that we've entered the late cycle portion of this economic cycle. So we produced a report last May and have been talking about the things that typically happen in late cycle. Growth tends to peak, inflation starts to strengthen, interest rates rise, there's increased volatility in the markets, and all those things have come to pass, as you've seen over the past few months. But we're seeing some things that aren't typical of late cycle, and I wanted to talk just a little bit about those, and then maybe have the consultants also comment of things we've been doing in the portfolio to sort of offset some of the concerns that we're starting to notice. The first is, when we enter late cycle, we typically aren't carrying a great deal of debt. So debt tends to peak during recessions and early cycle. Credit tends to grow strongly toward the end of the cycle, but companies tend not to take on a great deal of debt toward the end. But here we've got the federal government at $22 trillion in debt, and the Federal Reserve Chairman saying, we're not on a sustainable path here in terms of debt, so we're quite levered at the federal level. We've got $1 trillion deficit. We tend in late cycle to have surpluses at the federal level, but we're $1 trillion, almost $1 trillion in deficit as we sit here today. And we had a tax cut in 2017, which is unusual for a late cycle. Typically, tax cuts aren't made at that point in the cycle, or stimulus like that's not necessary in this portion of the cycle. And it's sort of, so the federal government sort of has things that it typically can do to fight a recession. It's been using here in late cycle. So it's a little bit concerning. We're trying to keep our eye on it. So that's sort of fiscal policy. Monetary policy, the Fed's in the same boat. They've stopped raising interest rates. That's news in the market, so that's a big deal. The expectation was the Fed would raise to about 3 or 3.5, stop and take a look around to see if the economy and markets could take even higher rates and perhaps proceed from there. They've had to stop at 2.5, and not for unreasonable reasons. The interest rate portion, or interest rate sensitive portions of the economy have been rolling over, so autos and housing, industrial and commercial loans, all those things have really slowed down here in the last couple of months. And of course, the stock market was exhibiting quite a bit of volatility. So they quit here at 2.5. We're a little concerned about that from the standpoint that possibly they could be done for this cycle. And we discussed this in depth at the investment committee meeting just a couple of weeks ago about how historically, at least if you go back to the 70s, there's been 6 interest rate cut cycles. Now, 2 of them came from very high levels. Chairman Paul Volcker at that time had put Fed funds rate up to 20%. He had to cut it from there. But if you look at the last 4, when rates were more normal or more reasonable, the Fed's cut between 500 and 800 basis points, or 5 to 8 percentage points, cut the Fed funds rate to stimulate the economy. We only have 2.5 right now, so they basically have half a bag of powder in terms of being able to cut the Fed funds rate in the next recession. Additionally, the balance sheet of the Fed's about $4.5 trillion now. That's 4 times larger than it, more than 4 times larger than it normally is relative to GDP. We came through or entered the Great Recession at about $400 billion on the balance sheet, and now $4.5 trillion. So much of what the Fed can do, or some of what the Fed can do, is hamstring for the next recession, which our base case is it happens next year. So these things we don't typically see in late cycle, either at the fiscal policy level or the monetary policy level. Some of the stops have already been pulled that typically are left available for the next recession. So have a little bit of concern about that. The second concern we have, or some things that we're seeing this cycle that we haven't seen in the past, is the amount of debt. And we mentioned the debt at the federal level. Consumers have also levered up, but in particular, corporations have levered up. And that's a little bit concerning. And also the debt quality of that debt is a lot lower than it typically is. So normally in the bond market, about 25% of the bond market is in BBB, the lowest ranking investment grade securities. 50% of today's market is in BBB securities. Typically in a recession, 7 to 15% of the bond market will get downgraded to junk, which causes problems. With 50% of debt now at BBB, one rung above junk, we expect that number to be much higher in the next recession, putting more pressure on the economy than normal from debt downgrades or corporate debt downgrades. And also the size of that market has really gotten big. 45% of GDP is now in investment-grade corporate debt, or the debt market is that large. That's larger than it's ever been as a percent of GDP. So when you add all that up and adjust for the size of the market, adjust for the lower quality, Morgan Stanley's got a report out that says we could see $1 trillion worth of downgrades to the investment-grade corporate market in this next recession. That's a big deal. So we're keeping our eye on that. We're a little bit concerned about that. It's no real surprise that companies have levered up, and it's mainly been a function of the quantitative easing that the Fed has done during this cycle. So the cycle's had very, very loose monetary policy. Most of the time during this cycle, Fed fund rate has been below the rate of inflation. That's unusual. And also the QE, the quantitative easing that the Fed did after the great financial crisis was over, put a lot of money into the economy. And corporations were very much encouraged to borrow. So the Fed was putting QE to hold interest rates down. And if you imagine that you were a CFO or a chief financial officer at a corporation, if you weren't out there issuing debt and pulling that capital onto your company's balance sheet, you were probably putting your job at risk. So companies did that, and they've really loaded up with debt this cycle. So we're watching that very closely and have taken some steps in the portfolio for when this does unwind in the next recession, that we'll be able to take some advantage of it. So that's sort of the situation we have right now. Growth starting to slow. We've got some concerns that we haven't seen in the last late cycle, the last portion of the last economic cycle that we're keeping our eye on. So we've been pulling back a little bit in the portfolio. We've been selling equities, as you know. We've been moving into income-producing assets. And we've got a couple of 2 or 3 new strategies that will pull, that once some of this stuff starts selling, we'll get into a recession, that will have capital available to buy in. But I'll turn over to Marcia Matias to talk about performance. And as we get to some of the private performance numbers, we'll have our consultants maybe address some of the way we're addressing some of these issues in the portfolio.
This is a handout, right, Vince, and not in the book?
This is a handout that everyone should have in front of them titled Executive Summary. This is a deliverable that we provide on a quarterly basis and provides more of a qualitative overlay to a lot of the quantitative numbers. We recognize that our materials can be relatively data heavy, so we want to provide a more digestible format. This is what the Executive Summary is really intended to do, and highlight some of the drivers. If I could turn your attention to page 6, we'll take a look at the allocations as well as the deviations from the allocations currently. You can see that both for the land grant and the severance tax, most asset classes are within their required ranges. There are a few core fixed income and non-core fixed income which are still moving towards their intended targets, so they're currently out of compliance. And if you look, one actually more or less offsets the other. So we've got about 3.5% in additional core fixed income, and that amount short on non-core. And as those opportunities present themselves, we'll continue to see that shift. And then real return is about 0.5% under the allocation. There were some structural changes that had happened. So again, this is more endpoint specific rather than what you would see long-term going forward.
Just for the newer members, if you look at that table, you can see there's an interim target and a long-term target. You're moving to the long-term target, but you can't implement overnight. So the interim target is closer to reality because it takes a while to fund private equity, and as Matthias said, some of the non-core fixed income, it takes
takes a while to find those opportunities. So that's why we show an interim and a long-term target at the top of the table.
Yeah, the private markets in particular are challenging because you can't invest, you commit capital, and then that capital is called and drawn down. And then, of course, you continue to have distributions, particularly with some of the investment strategies that make a lot of sense for this portfolio. So it's a constant moving target, and one of the reasons why you continue to see alternative strategies being brought before you for your review and consideration. On page 10, it's the investment policy review. This is quite important because it highlights what the objectives are as outlined in your investment policy statement, the guiding document for all of us as fiduciaries. And you can see that currently both funds are meeting their return objective, which is something that we certainly strive for. Performance listed down below, but there will be better assessments of that later on in the presentation. On the next two pages, I'll just cover page 11 quickly. Lay of the land. Now, this is only for a quarter. Frankly, I don't pay attention to a single quarter too much, but want to give you, especially for the newer members, the lay of the land here. This is an attribution report and really a scorecard in terms of what's working and what's not working, although, again, I would caution to read too much into a quarter. There's just too many moving things and too much noise in a single quarter to look at. Further on in the presentation, we have it over longer time periods, 1 and 3 years, that really is a much better gauge to see what's working and what's not. But so you understand what we're providing here. In the top half of that chart, you'll see the performance attribution. The green line is what the fund actually returned. The blue line is how much of that came from the policy, so essentially your asset allocation decision. And then the 3 smaller bars are subordinate decision points, and it's whether you have deviations from your policy target, whether you have unique style biases that you're expressing through your implementation of the various asset classes, and then of course the last one, whether the managers are consistently adding alpha. I will say that the yellow and the orange, which is the tactical asset allocation, essentially your decision of how you deviate from your policy allocation, tends to be very, very small, and that's by design. You're not tactical in nature. There's some structural friction in terms of moving in and out of asset classes and moving money around, and by its very nature, because you can't rebalance daily, there's going to be deviations, but it'll always be fairly small and generally not intentional. Sometimes that works for you, sometimes that works against you. And then the style, there you have a bit of a more unique implementation. So for example, in the U.S. equity portfolio, you have some extensive use of smart beta. You have more of a defensive positioning in some of your active managers. You have unique implementation decisions there. In your core fixed income, you have short duration as a one item that's unique or somewhat differentiated. So those decisions can add or detract value, and that's highlighted here. And then finally, the very last point is the manager value add in purple. So you can see that for the most part here, the yellow and the orange, I would just call it allocation differences from your policy and your style selection were accretive. Manager alpha in aggregate down slightly, but we're just talking a few basis points in a quarter. So again, if you look at this over the longer time period, over the 3-year, which is in the back of the report, it's much more in line with what we typically expect, which is that the tactical and the style, very, very insignificant, fairly neutral, and you actually have manager alpha of somewhere between 30 and 50 basis points over the long term, and that's something that we're generally targeting. So that would be more indicative of a typical time period. The one difference on the severance tax on the following page is the inclusion of the in-state private equity program. And you can see there on the bottom right that private equity is probably the biggest deviation, and that's negative 41 basis points on a relative basis, and that's because the program is lagging a bit on relative to the national program.
Because I hear people moving their pages, they're probably looking for that longer term number. So that's on page 39 if you want to take a look at that. I'd also point out that on the prior page, when Matthias was going over your policy, the policy period is to look at performance, outperformance over a 3-year period. But when you have a moment, look, because you've outperformed in each of the time periods shown. So, well done. Because it's on gross of fees over those longer term periods, in each case, outperformance. So.
The last page I'll cover before I'll turn it over to Marcia to tell you about the good performance is page 13. This is the schedule of investable assets, and it provides the cash flow profile of the entire program, and then more specifically for each of the funds. One of the things that's noteworthy here and that we've looked at for some time is the severance tax fund with its fairly substantial negative cash flow, or rather lack of contributions. Cash flows, especially if they're positive, can be a risk mitigating tool. This has been something that certainly we've talked about extensively, and the implications of it, specifically for the severance tax fund. And over time, as the funds continue to grow and try to maintain purchasing power through the growth of inflation, that will be certainly something of significance. And I would say that as the funds continue to achieve their objectives, they'll also be more susceptible to market moves. So we need to be very mindful that we have a strategy in place that mitigates and limits particularly downside volatility. And I think the strategy that you have with a higher focus on income, particularly in this late cycle, makes a lot of sense for that reason. But I did want to draw your attention to the continued cash flow issue, particularly on the severance tax. I'm happy to take any questions at this point. Otherwise, I'll turn it to Marcia, and she can provide you performance as well as...
Matthias, we do have a question, Tim Jennings.
When we look at performance, I don't know, but when we look at some of this at the bank and look at some of this stuff on there, it appears to be that it just seems like we're just about a stone's throw away from a major correction or recession or something. I mean, there's something, it's time for something for the worm to turn a little bit. And I'm just, to me, and I don't know, but if nothing else, just because we're really due for one. And where would we be when that happens? I mean, that's just, are we positioned well enough in a position where we won't be severely hammered? But even so, we have so much equities, it seems like we're going to get hit with something.
We're going to go through that in a moment to look how you position the portfolio. And as Vin said earlier, you have diversified your portfolio that was a bit of a headwind for you when the equity markets were going up. But you put diversification into your portfolio, in particular adding income to your portfolio in anticipation that strong equity market would not continue. And you look at this schedule of investable assets, we have not seen a gain loss negative for a long time. So the severance tax has been using a lot of money, but there's been gains to kind of offset that. You can see right now that there's no gains, and as Matthias and your staff have, and Janelle, by the way, Janelle does a lot of our work for us on your fund, and a lot of the reports you see is Janelle's work. So when they do that modeling, we've modeled kind of those difficult time periods that could happen for especially the severance tax.
Yeah, specifically, I think it was 2017, maybe it was late 2016, we did a liquidity study. It was 2017. So we modeled a 35% drawdown in the stock market, which is sort of an average bad stock market. We modeled that 35% drawdown to see what it would do to the funds and how much liquidity we might need to rebalance. So we've gone through that exercise and set that up in the portfolio to where that liquidity is available. I'm going to be coming back hopefully next month with Liquidity 2.0, and we'll talk a little bit about what happens when markets fall apart and what things might look like in the next big correction. I would agree with you that we think 2020 on the recession. Now, recession is usually bad for the stock market, but not necessarily very bad for, so we can have crises type markets separate from recessions, and recessions separate from crises markets. So the two don't necessarily have to happen at the same time, but just based on the briefing I gave you up front, we think we will get some pretty big correction all across the markets. In addition to stocks, with bonds and real estate, some of the other groups in this next recession. One thing we're also working on just at the moment with Matthias is what if the long-run assumptions that they have for all of our asset classes, what if we get disappointed versus those here in the shorter run, so in the next 7 to 10 years. So we're modeling a lot lower expected rates of return just to see where that'll put us, and if something comes out of that we think we can present to you, we'll do that.
I just wanted to follow up on that. I appreciate that. I'm going to guess that the members of the council would appreciate that, so that we can see what that trending looks like and that we are fully prepared to make investments and decisions that would be based on worst case scenario and best case scenario. So I think the details of that this group would like to see. So as that gets finished up, does that, Mr. Jennings? Okay. Anybody else on that point? Okay.
So if we go to page 15, the objective, the fund objective is listed at the very top for your investment policy, and in nowhere in those bullet points does it say you compare your performance to peers. And we acknowledge that, but we always get questions. How do we do compared to our peers? You are not and should not invest this money based on what your peers are doing. You should invest it based on your objectives and meeting the requirements that you have, which are, to distribute to beneficiaries. But with that said, we are showing you how you ranked. And this is a lot of information. If you look at the three top lines in the table, the top line is looking at the land grant total fund composite. That is your actual performance. So the quarter you returned and you lost 5.67%. Your interim policy did a little worse. Had you been at your long-term target, it lost a little less for that quarter. So that's for the quarter, and then you can go over and look at fiscal year to date and the 1 year and longer term. And as we said, you've done quite well. But now let's look to your peers, and we were showing you 3 peer groups. The first grouping is if we compare you to all public plans in the universe that have assets greater than $10 billion. And the population, there's 34 plans in the universe during the quarter that had 10 billion assets and greater. Well, how did you rank? And getting to Member Jennings' question, this is where your diversification paid off in a down market and has affected your trailing returns or ranks as well. You lost 5.67. The median plan in that particular universe lost less. So how you read this is that your rank for the quarter, you ranked in the 34th percentile. That's good. You want to be closer to 1 and away from 100, but you don't want to be at 1, because if you're going to be first, then you're taking risk and you're going to end, or you're either taking too much risk or not enough risk, and you're going to bounce from the top to the bottom, and we'll show that in a minute. If we look at the 1 year number against that universe, you rank pretty much the same, 35th percentile, so I would call that top third. If you go to your 3 year objective, you're at median in that universe of a lot larger plans. Now, if we go to the very bottom, we're looking at plans that have $1 billion in assets and greater, that are public plans. And the reason we show this, and just not the big plans, because we've been asked the question, well, we're a big plan. Why don't we always just look at 10 billion and greater? Well, if you look down at the below, you can see the median and the average. In that all public plans greater than 1 billion, the average size is 19.5 billion. So closer. So if you look there, you also ranked quite well. You ranked a little bit better. The median plan for the quarter lost 6.4. You lost only 5.67, so you ranked definitely in the top third there. But let's look at more positive numbers and look at the 3 year, which is your policy. Although this is not an objective, you gained 6.6 or 6.86. The median in that universe was 6.6, and again, you ranked in the top third. So although it's not an objective, it's good to see, and it's even especially good to see when your ranks are quite strong, and they're strong against your peers across the board. I also want to point out that the peers in this universe are just not sovereign wealth funds. They're public plans. A lot of them, the greater part of them, are pension plans. Pension plans have different objectives than sovereign wealth funds. So it's not a pure universe of funds just like you are. This is a public plans that include mostly pension plans and sovereign wealth funds. A lot of information on the page. The takeaway here is your diversification paid off. Your performance is strong, not only relative to your benchmarks, but also relative to your peers.
Just before Marcia leaves the peer relative, as you know, these are gross of fee databases. We tend to suffer a little bit in the gross of fee databases because we have a high percentage of private assets that are reported net of fees. So the difference between our gross and our net is about 20 basis points. The typical difference is 50 or more basis points between a gross and a net. So we do report into a net of fees database. Our ranks are usually 15 to 25 points higher in the net of fees, just simply because such a preponderance of our assets are private and reported as net into the gross database. So those numbers for that database, for the IFX, is 13th percentile for 1 year, 23rd percentile for 3, 17th for 5, 21st percentile for 7, and 28th for 10. So your top quartile across the board, almost out of 10 years. The 10-year number will flip into the top quartile, I think, probably this coming quarter within the IFX.
So Vince, just because so many people are new here, it's always good to remind people where we were 4 or 5 years ago.
You know what? I think a quarter or two before Steve and I came, we hit bottom. We were dead last in the database, so 100% down.
And let's, if I may, the Investor Force database that is on the front page of the SIO report that we've given you is what LFC uses to compare SIC, Para, and ERB.
Well, just so you know, we're testing that universe right now, and we'll be able to hopefully be able to show that in the next quarter or the quarter after. But we want to do our own testing on it as well. So you should have those numbers in front of you very soon,
so that we can cross compare both.
Yeah.
Okay. Yes, Harold.
Just Vince, you said some time ago, I think you and Marcia both in a meeting, that over the course of time, over the long haul, the idea is you want to be fairly close to 50%, because those that stay close to 50% typically do better. Should we be worried right now because we're doing so well?
Then you might want to go to the next page.
Yes and no.
The answer is actually yes.
The next page will answer part of the question. No, because this is the market we've set up for. So we would expect to perform well. You know how long we've been talking about stocks are expensive. Let's start moving away. Let's find these other things that will carry the load when stocks aren't doing so well, and boom, here it is. So we would expect to do a little bit better in these markets because we set up for them in advance. But the next page just shows our 3-year rolling rank, and this is in a gross of fees database, RBKs. But what's important here is if you look about December of 2013, so it's most of the way to the right-hand side of the page. That's about the first 3-year rolling number we have. And you can see historically either this fund was worst or first. And you can see shortly before, or I guess shortly after Steve and I came in, the 3-year rolling rank just about hit bottom. But you can see how much closer the dots are to the 50% line. And we've got about 2 dots above 50% for every dot we have below. That's just about right. I mean, we're never going to always perform above median in every time frame. But the preponderance of our performances are just above median. Very few funds have that kind of consistency. And so when you take that kind of consistency out over a longer period of time, your ranks just normally rise. So if we can maintain this kind of consistency, there's there's a fairly good probability that our longer-term ranks, our 7 and our 10, will rise up to the top quartile and stay there, just simply on the consistency of our shorter-term or shorter-time time frames.
Harold, any other questions about that? Anybody else? Peter, you were whispering to me. What am I missing?
I just think it's incredible. And I don't think that,
You were bragging?
I'm not bragging.
All right, I'm fine with that.
I'm looking
Bragging at this meeting,
Looking
you
at
know,
Steve and Vince
it's good.
saying,
It's good.
we need to remember, as we take lots of criticism always for small decisions, that big decisions over time have generated huge amounts of benefit to the state. And this council should be very proud of what we've accomplished since 2009, and be careful about self-criticism.
You look at this page and it gives like the left-hand side, that as a council, as a committee, that's stressful. You're either at the top, then you're at the bottom. I mean, that's where you are now is enviable. A lot of plans would be hugging that median because it does provide that consistent, less up and down, less stress. Page 17 is looking at the same rank information for the severance. It's very close. Matthias pointed out the differences. Page 18, because there are many of you that are new, this looks at your allocation by asset class compared to the other funds within those particular universes. So the $1 billion and above is on top, the $10 billion and above is down below. Just a couple comments here, and it's not perfectly broken out like you break out your asset classes, but it gives you a sense. You have less domestic equity in your portfolio than your peers. That, to Mr. Jennings, you go into a period of a recession. That speaks to your diversification. And you've added to your alternatives, your real estate, those things that provide diversification, alpha potential as far as private equity, and then also income, providing that income. So this is just comparing your allocation versus to that of the other plans within your universe. We could talk about that for hours. We usually talk about that when we talk about asset allocation. So that's enough said about that unless you have any questions. Page 19, I think, is also a very good proof is in the pudding. If you look at the left, these are risk return charts. The vertical is looking at return. The horizontal is risk or standard deviation, volatility of returns. The charts on the left-hand side is looking against that universe of greater than $1 billion. On the right hand, greater than $10 billion. So let's just look at the left on greater than $1 billion. The blue and the green are looking at, the blue is the circle is the severance tax, the green triangle is a land grant, and then the long-term indices are the yellow, or targets are the orange and yellow. We like to say you're falling in the northwest quadrant. You want to be, being that we're from the Pacific Northwest, that you're where you want to be. You have below median risk at above median return. That's exactly where you want to be. And you can see, looking from the bottom chart, which is 10-year up to the 5-year, how that shifted. That you have moved up and to the left somewhat, an enviable position. The same story, maybe not as dramatic, is looking at that universe of larger plans, those larger plans that are diversifying, have diversified similar to you, but you're still in that position of taking less volatility and having median or above return.
The way I think about this, just to sort of simplify it in my own mind, is that you've captured 106% of the median return with only 87% of the risk. So you're capturing more on the upside and taking substantially less risk than the median plan to get there. So I think oftentimes when you look at return, it's easy to get enamored by high returns, but what's lost sometimes is how much risk was taken on to earn those returns. And so looking at it from a risk-adjusted perspective here really shows how efficient you are in terms of generating return.
And we realize there are lots of risk here in the risk measures of volatility of return. Page 21 is looking at, we've talked about total fund. This is looking at the individual, the performance of the individual asset classes. And if you just look at quarter, you can see a lot of red, where the worst performing asset class for the quarter was U.S. equity. And then you can go down the line and see that the performance for fixed income was positive. I want to point out for those that you are new, for the private assets, those returns are lagged. You're going to hear, I'm not going to go into those because you're going to hear the performance from those consultants today for those asset classes. And then behind all these pages is a section on each of the asset classes. What I want to point out, and if you want to go through the individual asset classes, we can. There's been a lot of discussion and some changes in the U.S. equity portfolio. And what Starla and Vince have said, you can see on this page, is that U.S. equity markets, for the most part until recently, have been very strong, going up, up, up. But you underperformed your benchmark of the Russell 3000. Well, this was a period when everything goes up. This time, indexing does better. But I want you to look at your rank. The number down below that in the first section under the green under U.S. equity shows your rank. And Vince has mentioned this before. Is that although you might have underperformed your Russell 3000 benchmark, look at where you've ranked. You've ranked above median with your domestic equity composite. So you've done better than your peers, many of your peers, with the structure of your domestic equity portfolio, and you'll notice that you outperformed with the changes that you made in the portfolio for the fiscal year to date and quarter to date. Happy to go through any of these composites. We'll note that you are diversified in your fixed income. We have two yellow sections, a core fixed income, which is more traditional, and your non-core. Certainly non-core had a tough quarter, but if you look beyond, beginning with the calendar year to date, having that diversified your core fixed income, having diversification beyond your core fixed income has been additive to the portfolio. You can see the non-core, although it takes a little bit more, it has more volatility to it, has outperformed your traditional core fixed income. And then you can, as I said, your other consultants will talk about the performance of the private asset classes. Each section behind looks at each of the asset classes. The first page tells you if there's been where you are versus your target, if there's been any changes to the portfolio, and if there's been any changes to the individual managers within each of those asset classes. Beyond that, that's our quarterly report. So well done, you. It's outperformance and ranks.
Thank you. We have a question, Olivia.
Madam Governor and Marcia, what do you consider core and non-core fixed income? What's included in it?
Core fixed income, you do have an unconstrained portfolio in there, but it's your more traditional core fixed income. You've got, I guess if you go to page 42, this includes some of your non-core, but it's mostly your core fixed income portfolio. It includes your unconstrained managers, but you can see the allocation by sector for your fixed income portfolio here, where you have treasuries, you have some agency mortgage backs, you have investment grade, non-investment grade, bank loans, some emerging market debt.
I think, Marcia, the question is, how do you distinguish between core and non-core events?
Yes, Madam Chair. So the bond market I was talking about at the beginning, that's core bonds. So investment grade credit, treasuries are usually pretty low. We've really moved away from that. We were about 25% in those markets. We're 10%. And we've restructured it away from credit and away from duration. So we've really changed our exposure to core bond markets. Non-core are those things that Marcia was showing you, just different types of asset-backed, commercial mortgage-backed, some munis, a little bit in there, but primarily it's different type of debt than that corporate debt that we're really afraid of right now and are staying away from.
And you don't have a dedicated allocation to hedge funds anymore, and you brought that down dramatically. There are some credit-focused hedge fund, although that's reducing over time. So it's a very diversified pool of non-traditional fixed income.
Before we, sorry.
We have another question. Linda?
At first you might say, well, isn't it kind of scary to be saying that we are reducing our allocation to core and going to non-core when you are reassured how conservative core is? Well, so many people are new here, you don't go back to our original liquidity study. And the liquidity study is what's so important, because what we're looking at is with a severe drawdown in all asset values, what is the liquidity needs for a period of time that is more than reasonable, and we don't need to stay in conservative assets for more than that particular amount. So that permitted us to go from the core to the non-core and fixed income. If you'll look at page 21, where they talk about non-core, that's highlighted in yellow, notice that just the current year to date, the portfolio did 3% in last calendar year. The non-core custom index is at negative 81 basis points. We got 3.81% superior performance by being in the non-core portion on the fixed income. So it ended up being a superb move for us and gave us the flexibility to outperform in that category and not stay in core when it's unnecessary for us to be so conservative with our bond portfolio and the entire bond. But these are the type of things, and actually it was the brilliant liquidity study that the State Investment Office did that allowed us to make that decision. And they're coming up with the second version soon. So as you gain experience here, you'll see how this all has fit together and how we're getting superior performance, and why, although it didn't sound conservative that we're not in core as much as we used to be, it was a very prudent move.
And also the non-core allocation lets you, the opportunities in fixed income change over time, and having the non-core, you can take advantage of those mispricings in the market.
That's helpful. Thank you.
Any other questions on that point? Okay.
Madam Chair, before we leave the broad portfolio view and go down to the smaller asset classes, Lee Rawson had asked to see a chart on that we fairly regularly do with ERB and para identified on that chart. So that's on page 158 of your materials. Now the LFC compares the performance of the three state funds historically in a quarterly report. We make sure you all see that. But this is a look forward of how we're positioned relative to other public funds.
What page is that?
158. 158 in the.
He's right there. I got it. Thank you. I'm getting personal assistance. Boom.
So because of a lack of
I'm starting
imagination.
to like you.
Because of the lack of imagination, I think we call this our black dot chart. Normally, we just identify the land grant fund, which you can see as the blue triangle. And what this does is we take the asset allocations from 37 funds. We run them through RBK's risk return and correlation assumptions, and then we plot them on this chart. So this is what a big chunk of the other public funds are expecting from their portfolios going forward, using RBK's assumptions for risk and return. So returns on the y-axis and risk is on the x-axis. Land grant's positioned fairly well relative to the pack. So it's not a surprise that we tend to have above median rankings, mainly because of our positioning relative to others on expected return and expected risk. So we're out there about 12 3/4 volatility. Portfolio now on the 2018 assumptions is expecting almost 7% rate of return going forward. Better than most is expected. ERB is fairly close to us, both in terms of risk and return. New Mexico Para over the past few years has taken some risk out of their portfolio intentionally. That's why they're a little farther down the risk scale there. Now, they're doing an asset study right now, and of course I shared this with the two other CIOs before I put it in the public materials, but if you use their new allocation, which they're not at yet, their diamond moves over to the left to about 10.5 volatility and straight across. So they're getting the same return, but they've taken about 0.7 out of their vol. So it looks like a more efficient asset allocation for them without giving up any return. I don't know how quickly they'll move toward that, but they've decided on that new portfolio.
And is there a simple statement as to what they've done, what kind of change they've made that would?
They moved into risk parity, Peter. It looks like the biggest thing. Although it's a different types, really pretty interesting. I'll tell you that.
Yeah.
So anyway, that's our positioning relative to the peer group in terms of a go forward look. So we give you the rankings on how we've done in the past. This is how we expect it to do in the future, sort of on a longer term basis.
Any questions for Peter?
For Vince.
I'm sorry, you're Peter. Any questions for Vince?
I have no answers. Vince has all the answers.
That's why I like to share the meetings. We're teasing everyone.
Is the severance tax primitive fund about the same spot, or where?
The allocation is pretty close, so it would overlap that time.
Okay. Any other questions? Okay. Thank you, Vince.
So we've got the private asset classes, Governor, for their performance.
Okay. Please proceed. I think they always see it on us. Yes, it does. Proceed.
Good morning.
Good morning.
David Lee, Private Equity Director. We're going to be going over the performance of the National Private Equity Program. This presentation starts on diligent page 159, and we have our usual familiar faces here, Richard Pugmire and Alan Waldrop from Pavilion Associates. Go ahead, Richard.
Well, I'll start on page 4 with the performance dashboard. This is the National Private Equity Program, and there's a lot of numbers on this, so I'll walk through them and talk about what they mean. We'll start with the date 2, the as of September 30th, 2018 performance. With private equity and private markets in general, the performance is delayed. Typically, fund managers will get us performance 45 to 60 days after the quarter end. And then for the annual reports, the December 31st, it's typically 90 to 120 days because the funds get audited, they get their performance audited. So those reports take a little bit longer. And so you'll be hearing the Q4 performance report in May or June. This table has numbers since the inception of the program, which goes back to 1988. A lot of the activity has been over the last 20 years. But the first commitment was made in 1988. And on the left side there, you can see the active commitments. Those are the funds that currently have value or are currently active in your portfolio. And then we have liquidated funds, those funds that are no longer active and have liquidated all of their assets to you. And then the sold funds, those are funds that we've sold on the secondary market. There hasn't been a sale on the secondary market since 2014. So it's not something that's very common. Looking at the different columns, we have number of funds, the commitments. So with private equity, you make a fund commitment, and then over time, what we call the general partner or the fund manager has the ability to draw that over an investment period. And then they'll invest that money and then return it to you over time. So the net contributed is what they've drawn, the net distributed is what they've returned, and then the net asset value or NAV is what the current value is in the fund. And so that's the explanation of the columns. The total value is simply the addition of the net asset value and the net distributed. So it's basically what did they generate for the capital that they drew from you. And then we have two different performance measures that we look at with private equity. One is a net multiple. So for every dollar that they've drawn from you, what have they generated with it? And so you can see as of September 30th, 2018, 1.48. So for every dollar they've drawn, they've generated a total value of $1.48 as of September 30th. And then the net IRR, this is a little different than time-weighted returns, which you're probably used to seeing on most performance reports. This is a dollar-weighted return because these managers have the ability to draw capital and they also choose when to return capital to you. And so it takes that into consideration. And that return is 11.5%. So looking at the totals, over the history of the National Private Equity Program, you've committed to 208 funds. They've drawn about $4.2 billion. They've distributed back to the State Investment Council about $3.9 billion. There's currently $2.3 billion approximately of net asset value as of September 30th. So the gain is approximately about $2 billion since 1988 on this program. And these are all since inception numbers. And so one of the things we added for this quarter, some of the council members and on the CIC wanted to see what has been the impact of the recent fund commitments. We started the program in 2011, started making new fund commitments. And so the chart at the bottom, it shows kind of the evolution of the contributed, distributed, and net asset value that I talked about, but it also has a line graph there that's the rolling 10-year net IRR. And it splits in 2014, and the way we decided to show it was what was the rolling 10-year net IRR of those 2009 and before vintage year funds, and what is it for the entire portfolio? Because those funds that you started committing in 2011 don't have a 10-year IRR at this point. And so this shows you the impact of those new fund commitments. As of September 30th, you have a 9.6% 10-year net IRR. If you take out those 2011 and after, the 10-year net IRR drops to 7.5%. One of the things about private equity is it does take time. You make a fund commitment today, they're going to draw capital over multiple years. And you can see that down below here. As a percentage of NAV, even though we started making commitments in 2011, it wasn't until 2015 that more than 50% of the net asset value came from those newer fund commitments of 2011 and after. But now they're 87%, so the performance going forward is largely driven by those newer fund commitments. Any questions on that slide before I move on?
Anyone? All right, thank you. Keep going.
The next slide is just shows the different components of net asset value. So with private equity, net asset value going up or down doesn't necessarily give you much information. A net asset value could just be going up simply because a fund is drawing capital, and it doesn't tell you anything about the performance. So what we like to do here is break down the components of the net asset value changes for you. So you can see here in the middle, the June 30th net asset value is about $2.2 billion. And we had about 118 million of contributions, 106 million of distributions. We had a gain of 67 million, and that's how we get to the September 30th net asset value. So it just shows the different components, so you can kind of see how the portfolio's actually performing. And there could be a loss, but maybe a fund is drawing a lot of capital, and that's why the net asset value is going up. And so that gives you a little bit more information about performance. And then on the next slide, we actually give kind of the top 5 drivers of all those different components: the contributions, the distributions, and then the fund gains and losses as well.
And I think just to highlight, that's why we have to come back regularly. When the distributions come back to you, it reduces your allocation, and we have to sort of keep feeding new commitments into the pipeline so that we get the contributions so you can get to that target that they were talking about.
And that's where the pacing model comes in.
I'm going to move to slide 7, which is the performance by vintage year. We've talked about performance on an absolute basis up to this point. This is a relative performance comparison. So how is your portfolio done compared to other private equity funds? And one of the ways we divide the portfolio is by vintage year, which is the year that a fund started drawing capital and started investing. And so this is going back to 2000 by vintage year.
Excuse me, page 165.
Okay.
Great.
Thank you. And you can see in the color-coded columns, that's your net IRR and your net multiple as of each vintage year. And we've color-coded it depending on where it falls against the benchmark, whether it's top quartile is green, second quartile is yellow, third quartile is orange, and then bottom quartile is red, which thankfully we don't see any red on the page. And then we actually show kind of what the breakpoints are for the Burgess North America Private Markets benchmark there. And I mean, the theme here is 12 of the 15 vintage years going back to 2000, the net IRR has been above median, which is what we're targeting. And then 11 of 15 on a net multiple basis have been above median. Another theme from this too, if you look at the performance, it does kind of vary from vintage year. So some years, for example, in 2001 you had a 19% net IRR, whereas in 2006 you had a 6% net IRR. So you never know when the good vintage years are and when the bad vintage years are. So one of the things that we talk about in the pacing is you want to be in the market every year committing to funds, and that's why we don't try to overdo it in any one year by committing to a lot of funds, because you never know when a vintage year is going to be better than another vintage year.
And a vintage year is an indication of when you start investing. That's how we try to measure these funds on an apples-to-apples basis compared to each other.
When did we decide you're going to go to Burgess? I think this is probably a great move, but I just wanted to inquire why we're doing that move and when we decided.
Yeah, so we used to use Cambridge. We actually put together kind of some research for staff, and also it corresponded with staff actually subscribing to Burgess and getting more information on that. But Burgess has more funds in their sample, and that's one of the problems with private equity benchmarking, is there's not a perfect universe out there. It's not like stock indices where everything is transparent. And so these benchmark providers are trying to put together as big of a universe as possible. Burgess had a larger universe for us, so we liked using that. It's also used in a lot of academic papers, so the academics like using Burgess. So we decided to choose it to move, and then it also corresponds with staff's additional analytics that they get with their Burgess subscription.
The other thing is the Cambridge data comes from the Cambridge client base, which tends to be more endowments, foundations that have different access to and exposure to things like venture capital. So the Burgess portfolios and where they're getting the data from tends to look more like folks like yourselves. So it's a little more comparable.
It's not that easy to get a lot of drill down data about the Cambridge indices.
Any other? Olivia.
Governor and presenters, so is it unusual that since 2000 we've never had a negative internal rate of return?
It's varied over time. It has been negative, especially the 05, 06. I'd say 7 years ago those were negative. And over time, as they grow value in these companies, and these companies get better earnings, then they sell them at hopefully a higher value. That's where you see improvement over the long term. But the median returns have never been negative over this time period. If the returns are quite wide on dispersion, so that's why manager selection is extremely important. So you could potentially get negative returns if you don't do a good job at selecting managers.
And you tend not to be in the more volatile, you have less exposure to venture capital, which has a much wider swing. So the lowest return in venture capital compared to the highest return has a much larger spread than, say, in buyout or growth equity or special situations. So it can be more volatile, and that cuts both ways.
So during the recession, these don't seem to be impacted, or at least the year-to-date or the life-to-date.
Where you see the impact is if you look at the sort of 04, 5, 6, and 7, if you look at the median numbers there, what happens in those cases is the funds have called a fair amount of their capital. So typically if you've been investing for 2 to 4 years before a recession, that's where you're exposed. Because you've got money in the ground in companies, the recession hits, and you're trying to get back to even or maybe a modest return. Where you've invested, say, in 08 and 09, immediately preceding a recession, folks didn't have a chance to invest that much. So they got to deploy most of their capital at lower points in the market, sort of post-drop, and then ride that up higher. And that's why it's always important to be in the market, because we never know exactly when those time periods will hit. But also, so that's kind of the general numbers. In your particular numbers, there's also manager selection that goes into that.
Any other questions? Yes.
I've got a question, but it's not. I'm not sure if this is the right point. But we know that in private equity, you got a lot of winners and you got a lot of losers.
Mm-hmm.
What is the average in the national program between winners and losers? Not in terms of dollar amount, but in terms of entities.
And how would you define the people that are exceeding?
Well, companies that we end up exiting at a loss. Do we have any analysis? Because I know we're going into funds. We're going into a number of funds, but each fund is going to have some companies that we exited at a loss and some that are exited at a gain.
So typically, when we're looking at buyout funds, which is the vast majority of what you do is growth equity and buyout. Buyout tends to have loss ratios where they've actually lost money on a transaction of less than 10% of the capital. So, and we see some folks that have very low loss ratios, and other folks maybe in more volatile strategies where they're doing a turnaround or a complex carve out or something like that. They might have a little bit higher, but they make up for that with some higher return. So they have a bigger variation. Growth equity, I don't know what an industry norm is, but you'll hear from the folks at TA, they haven't had a lot of losses. And so the spread is actually quite narrow in the categories you're looking at. Venture capital, the loss rates are much higher because you're counting on that, particularly the earlier you go, you're counting on that very big win to make up for a lot of losses.
Well, I guess what I'm trying to compare is if we were to go back to 19, page 23 in our documents, what we have is the percentage of companies in New Mexico that we've invested in, which we've only had 1/3 of the companies that we've exited at a profit. 2/3 of the companies we've exited in New Mexico have been at a loss. So I'm trying to compare that net company compared to what we're doing in the national program. In other words, is that an excessive number for New Mexico to have 1/3 successful companies, 2/3 unsuccessful?
We could do, it's probably not right to draw it directly to the national because it's different categories. These tend to be much larger, more established companies versus earlier stage venture. But we could run an analysis of what the broad venture market looks like in terms of loss ratios compared to the New Mexico statistics, which I think would be much more comparable.
And I don't know, Senator Rawson, if this translates in the same way, but to try to compare, because as a member, I'm interested in appropriately continuing investments in New Mexico companies and recognizing that we have to understand the risk in order to make those decisions. But to compare, because you don't want apples and gorillas here by these huge companies that have a whole different structure and opportunity, but rather at states with similar investments and similar capital problems that we have, so that we can see whether we are doing it productively or we're taking too much risk. Because otherwise, I think that the information that would be provided would show us that we can't compete and would drive a decision potentially unfairly and not very objectively away from that part of our investment portfolios moving forward.
We do work with the state of Utah, for example, and so we have examples we could use there. California, we've got data, but it's a big
skewed.
Yeah, different regions of the state might be more applicable than say Silicon Valley.
We've got a lot of venture capital data, and it's not uncommon for a venture capital fund to have over a 50% loss ratio. And then they're really relying on the 2 or 3 big hits
that hit big
to get their returns.
Would that meet your requirements? No, I don't want to take it over, but
no, exactly. Okay. I know we need to compare to more like-sized funds, but I'm just concerned when historically, and of course we're going to go back to where previously the investment council was making decisions for individual entities, which we're not doing now. But when you only have 1/3 success, it seems a little. We're gambling on the really big wins to offset the number of losers.
Which is how that market works. But I appreciate that review, so that this group has to be able to defend the decisions that we support And we want to be able to do that productively. And it gets back to the earlier overview about education and making sure that folks understand how these decisions are made and in what context. So I think that's right along the path that certainly, as I'm learning this, that helps me justify the positions and decisions that we make, the positions that we're in and the decisions that we make. So I appreciate that. I just want to make sure I'm not modeling it in a way that doesn't give you the data that you need. Okay.
We will do that.
All right, perfect. Okay. Any other questions?
Just
you need a phone book, Senator Jones?
You need one? I have 2 or 3.
I'll just hit on 2 more slides real quick, and then I think we've basically covered all the major points. On page 8 of the report, which is the next page after the benchmarking, in addition to comparing against other private equity funds, one other measure we do, it's called the public market equivalent, where you basically take these cash flows, the contributions and distributions that are coming in and out of the fund, and instead of going into a private equity fund, you kind of hypothetically invest it into a public equity index, and then calculate what that return is. And over and we do it on a 10-year basis. Over the last 10 years, the private equity program has been underperforming the Russell 3000, Russell 2000, and S&P 500. It's really kind of a common theme across private equity. You can see it in the benchmarks where the difference is a lot closer now, because of the strength of the public equity markets over the last 10 years. And then finally on page 9, we last did a structure study January of 2018 on private equity and put forth these strategy targets. And this basically is a summary of where the portfolio stands against these strategy targets. One is the annual commitment range. It's 550 to 650 million annually. In 2018, we were below that. One of the reasons why is because with private equity, you want to be very selective on managers. We're not just going to deploy the capital to deploy it if we don't have high-quality managers. One of the things we do with our process is we're looking out in 2019 and 2020 to see what funds are coming back. And you can see that already this year. We already have, it's February, we already have 1 fund coming, and we're probably going to have some more funds coming in March. So it's an active 2019, whereas 2018 wasn't as active because we didn't see the quality there that we do now. As far as strategy exposure, sub-strategy exposure, everything's in the range except special situations is up slightly higher. These were revised down for special situations in January 2018, so you get to it over time. We can't do any rebalancing because they're illiquid assets. Geography is within range. As far as manager concentration, we do have one manager that's above the 10% exposure. They are generating about a 15% net IRR for you, and those funds itself are diversified across different sectors, so we're not too concerned about that. But where this exercise really helps is in figuring out where to size somebody like a TA that we're bringing to you today. How much money should we give to TA when we're looking at these concentration limits? And then we have 7 fund series greater than 5%, but all but one of them are generating more than 15% at IRR, so they're doing really well.
And just to remind people, these are just guidelines we use. These are not limits. These are not things we need to rebalance around. They're not constraints. They're just things to help keep us focused on making sure there's a diversified and balanced portfolio. So you will see some lumpiness just because of the nature of private equity, but we're trying to stay within these, but there's no penalty or action to be taken if you go outside the bands.
And finally, managers and funds. We want to have a concentrated portfolio of managers and funds, and we've done that since 2011. We've done 24 managers since 2011, but it does take time with the legacy portfolio and that winding down. There's 121 active funds. You can see the number there. 68 funds have a vintage year of 2007 or older, so more than 11 years old that we continue to work with to try to get liquidity from. And we are seeing more funds liquidate each year, but it's still a long process.
Thank you. I don't think we have any other questions. All right. I believe we're on, okay, yeah, that sounds, so we're on item number 3. B3, is that correct, everyone?
Discussion? Yeah.
2B. That's what I said. That's what I thought I said.
Good morning. Paul Chapman, Director of Real Estate and Real Return. So we have Townsend. Townsend does about 90% of our underwriting in the real estate, well, all of our real estate and most of our real return portfolio. So they're going to handle the reporting, which they call the PMRs, for the third quarter of 2018.
Great. Just based on Vince, good morning, everyone. And based on Vince's comments, I just wanted to provide a couple of comments with regards to the market in general, and taking into consideration some of the investments that we've made over the last couple of years to position the portfolio in and on a go-forward basis. So, as I've mentioned before, over the last 10 years, it's been a great time to be a real estate investor. If you look at the returns, there's been double-digit returns, almost over every single one of these periods. However, we also recognize that trees don't grow to the sky, and we need to ensure that the portfolio is properly positioned. With that, real estate has the valuations that we're seeing today in real estate are high. And so, however, fundamentals are still healthy. And a couple of reasons for that. So we've had limited development. If you think about when we went into the GFC, the recession of 2007, 6, 7, 8, we had a lot of speculative development that was taking place. We also had a lot of leverage that investment managers were putting onto these assets. So that leverage, coupled with no income coming from those assets when the recession hit, really put real estate in a bad position. We don't have that today. We don't have that speculative development across the country. There are certainly pockets, by all means. So I'm talking generally, but we're in a much more healthy environment today than we were at that point. Leverage, we are seeing some loosening on covenants and things like that. However, we're not seeing over leveraging, and that's another good data point. The last piece is really the supply-demand fundamentals. We still are seeing positive population growth, positive demand growth from a GDP perspective in most of the markets that we're investing in, obviously providing them demand for real estate. So all of those things put together provide a relatively strong environment for real estate, albeit we also are very cognizant of many of the data points that Vince mentioned leading off this morning. So what are we doing to try to focus the portfolio and make sure that we're in a position to continue to excel, but also to ensure that we have some downside in the event of if and when we do hit that recession? So a lot more of the focus recently has been a bit more tactical. So looking at investments that are producing strong income, so an industrial asset that we know has good quality tenants in it, or a multifamily asset that has good quality, high lease type asset that has good income coming from it. We're also looking for opportunities that actually have assets. So instead of going into a blind pool type investment, we're looking for investments that have a pool of assets that exists, that we can feel, touch, really understand what the fundamentals of those particular assets are. And lastly, we're seeking more thematic investing, and that could be debt. So we're limiting some of the downside, and however, we do have strong income coming. We're also looking for more thematic, for example, industrial assets. Industrial has benefited at the expense of retail. And so instead of going from historically over the last 10 years, the industrial momentum went from providing consumers across the entire nation with 2-day delivery. So over the last 5 years, we went from 20% of the population having more than 2-day delivery to now where 80% of the population has 2-day delivery. The next momentum is going to be same day or 1-day delivery. So where are we positioning in industrial? We're looking for more infill locations that are around major CBDs, so consumers can participate in that same day or 1-day delivery. We're also looking at retail where individuals want to live, work, and play. Retail is very dynamic right now. We're seeing it. It's at the headlines almost every day in the newspapers. There will be winners and losers. We believe that by positioning portfolios in those environments where retail where we're buying retail that's living in an environment where people are living possibly upstairs and coming downstairs for their coffee or coming downstairs for their fitness or their dry cleaning is where we want to be. And so with that, we've made investments along each of those themes over the course of really the last year and on a go-forward basis. So in industrial, Exeter and LIT, very strong industrial managers. Asana, when we think about retail, those those environments where they're investing in those environments where people are living, working, and playing. And then lastly, on the credit side with Brookfield and Ayers. So we believe that does provide downside and strong diversification in the portfolio, and we'll continue to look for those type of investments as we go forward here. I think that all of those comments will resonate in the performance that Seth will talk about here in a second. But I'm happy to answer any questions broadly on that macro sort of market overview.
So, residential units in London seem to be weakening, according to stuff I've been reading. How exposed are we now in our international?
So today, the international we can break down specifically for Europe, but we have a target of around 25 to 30%. I think today overall 9% in Europe.
But only a small segment of that. That's all of Europe, right? And we've got student housing in Europe, we've got industrial in Europe, so it would be a very, very, very small part of our portfolio.
And frankly, what's going on with Brexit may present some opportunities.
If we have the liquidity.
If we have the liquidity, and many of our global managers are looking for opportunities where they can be tactical and take advantage of some of that as it continues to unfold.
Do we have any other questions or comments?
Great.
All right, thank
so
you.
I'll take you through a little bit of the performance here. Pavilion did a great job sort of giving you a little background on some of the definitions and some of the terms, so I won't repeat that. But a lot of the same things that they described are prevalent here in the private equity real estate than when we get into the real assets portfolio. So again, starting on slide 4, I believe it's 180 of your book. Don't correct me if I'm wrong, but this is really the beginning of the real estate portfolio performance slide. And again, this is third quarter performance because of the lag in private asset reporting. And also, you may recall, and for new members, we do a very deep dive for year-end performance. We do a slide on every single investment within the portfolio. So we'll spend a lot of time on some of the specific investments next quarter when we do present performance. But this is sort of an interim performance quarterly report. As you know, we target outperformance over the longer term, the 5+ year performance. We added 7-year for the first time now that we've sort of longer into the real estate portfolio on this table. But I'd highlight the continued outperformance on slide 4, really over the short term, the 1 year, the 3 year, as well as the 5 and the 7. With that said, the number that most of your eyes may jump to is the short-term underperformance of 10 basis points under the current quarter, and this is consistent with what we've seen last quarter as well. We've seen some fluctuation in currency movements. So what we've seen in the portfolio, we have 9% to Europe. We have a similar allocation to Asia, roughly about 18-20% of the portfolio invested internationally, and over the last 3 years, we've seen currency gains in the portfolio. So we've seen improvements in our performance due to the dollars coming, or the euros coming back to the dollar, or the yen coming back to the dollar. We're giving some of that back, so we're seeing some volatility in the quarterly performance and some quarterly valuation. So the other impact is really, we look at some of our investments are longer in their life cycle today, so less quarterly valuation changes quarter over quarter. So a good example is Harrison Street was an investment we made about 7 years ago. This is a U.S. targeted investment that invests in alternative property types, so senior housing, student housing, basically not the traditional apartments, multifamily, or apartments, retail, industrial, and office. And they have delivered a 12% IRR since inception, a 15% 1-year return. But in their current quarter, it's a 0.2. So quarter to quarter, they didn't have money valuation changes, but over the 1-year period, they're still a strong 15%. So we're seeing just some volatility in that quarterly number. Nothing that today is overly concerning. We still see how that's not really impacting the longer-term outperformance. So although it makes up 25% of the 1-year return, we're still outperforming by 260 basis points, and so on down the list of the outperformance. We will see that the 5-year performance of outperformance of 180 basis points, that bottom right number on the 5-year total net, is 180 basis points. This is up quarter to quarter about 20 basis points as the portfolio has had a strong 5-year gains. Again, we're showing double-digit returns over the current year, which is above our long-term expectations. So our expectations are in that 7 to 9% range, 10% outperforming that. That is due to some of the recent performance. We've discussed in our significant weighting to industrial today. We've had some significant gains in industrial, 40% quarterly returns, which are really driving that outperformance. We do anticipate that to moderate. You see that the index is at 7.7. We estimate 7 to 9, so still within that range and a little bit of outperformance from our projections. When we look at the total market value of the portfolio versus the total plan assets, we're at about 8.8% of total plan assets versus a 12% target. That was increased from 10 as of third quarter 17. Given the recent equity performance in the fourth quarter, we expect that number to change considerably when we come back with fourth quarter performance. That will increase due to the denominator. But we are seeing capital funded into the market as well as capital being returned. So when we talk about investment pacing, that all files into that model. The unfunded commitment amount did decrease quarter over quarter. About $55 million was called and invested into the market. So leaves at about $800 million of unfunded capital. So if we look at unfunded capital plus the plus the net asset value today, we're about 12.3% of total plan assets. We do anticipate, we do need to further make additional commitments to really achieve that 12% on a funded basis. There's a definition here. It's a rebalanced portfolio versus since the 2011 portfolio. Maybe I'll take a step back and just define those. So when the SIC turned over and when the staff turned over in 2011, we really had a bifurcation of the portfolio. So investments made from 2004 to 2009 are we consider legacy investments, and then new investments from 2011 going forward. The 2011 going forward portfolio now represents 96% of the net asset value, so it's largely the driver of performance. That portfolio individually has delivered over a 12% return over the 5-year period. Those legacy investments still on the portfolio, we're still monitoring those. Those are active sales. In fact, just today we received about a $4.5 million distribution from one of our student housing managers, but that represented about, over the 5-year period, about a 4.5% return. So that is winding down, but it is included in the total portfolio performance. If we move ahead, just looking at slide 6, which again I think is 182, describes a little bit of our pacing model. You can see that legacy portfolio from 2000 to 2007, and then with a gap really where no investments were made, and then we started back up in 2011. You will see some volatility in these numbers, and you'll see the different shadings. So just take a minute to look at this chart. The significant dollars that went out since 2000, and really 2012 and again in 2015, were core investments. So prior to 2011, there was no core assets in this portfolio. So back to the question earlier about fixed income, what is core real estate? These are prime markets, large assets that are 90+% leased, really driving income through the portfolio. Really, the reason we are investing in real estate, so that income generation for the real estate portfolio. And probably about 20 to 30% of that is returned from core investments are from appreciation. The opposite is true for non-core. So less income and more appreciation.
And core really gives you the attributes of the asset class. So the income, the capital preservation, the correlations against other asset classes. That's really your beta, if you will, in the real estate portfolio.
So you'll see some significant core commitments. Those are also within our portfolio. All of those are open-ended positions today. So what that means is you have quarterly liquidity in a functional working market. You can add capital, you can redeem capital, but that capital is out there for a long, sustained time period. Versus closed-end, where you're having to constantly replace capital as assets are bought, fixed, and sold. You get that return of capital. So we're seeing less commitments going forward because those core dollars are really out there in perpetuity, and so we make rebalancing decisions. And that's why when you look going forward, we project sort of from the 250 to 280 range of 250 million to 280 million of new non-core commitments going forward. That's consistent with what we've sort of done over the past handful of years, and that's sort of where we're at today. When we look at 2019, so the current vintage, we've actually fully committed to the $260 million across 3 funds. These were really made late stage, fourth quarter of 2018 based on timing. There were some fee breaks to get in early. There was also we knew we were going to do these investments, and waiting until January just didn't, for the sake of a calendar year, didn't make absolute sense. So a lot of that money was pre-committed. However, we still do monitor the portfolio pipeline and investment opportunities. We are going through additional pacing models and updating those periodically, and we'll see if there is additional capital to commit, as well as if there's really just a strong opportunity that presents itself. The next slide I'll talk about briefly is one that's been in here in the past, but maybe takes a bit of an explanation. Is on slide 8. I believe it's 184 of your book. So this is real estate potential fee savings, and I know fees are a constant point of reference and review within the pension plan or within the sovereign plan. And here we show fee discounts that you all have achieved through your affiliation with Townsend. So you'll hear about investment later today with Brookfield, and there's a fee discount here because we're being a larger commitment and a first close investor. Those types of fee discounts are not included in this chart, so that's in addition to this chart. These discounts here, we were able to achieve about $2.4 million of annual fee savings, so that's every single year, $2.5 million, based on just aggregating commitments across Townsend clients. So Townsend has a very deep resources, large depth within the marketplace, and we're able to further negotiate fees on your behalf as well as on other clients. So this is an additional fee savings that you all have received. The last slide I did want to chat about, and then there's a number of other slides in here on the attribution, is the public market equivalent slide on slide 188 of your book. So here we look at the public market equivalents from since inception of the portfolio on the left-hand side, 6.2 versus 6.2, so we're really matching from a public market equivalent standpoint. But when we look at just that new portfolio since 2011, you see a significant outperformance. So the 12.3 versus the 6.8. So really that new portfolio is really driving that outperformance. With that said, there's a lot of other slides in here. I know I'm speaking pretty quickly here as well, but wanted to just open up to any questions at this point.
Do we have any questions? Yes, sir. Mr. Treasurer.
Thank you, Governor. Would you go back to slide on page 185? Because that's later on that's on list here for action.
Sure. So what we do, and this is on the significant events slide, is we look at each of your on a quarterly basis, and we're monitoring these funds regularly for anything that are changed. So there's amendments, there's any issues within the portfolio from asset level to investment team level. So during the fourth quarter, the fund here referenced Berkshire Multifamily Income Realty Fund did have a portfolio manager change. This was one that we were well aware of before it happened. We were actually pretty vocal in effectuating this change. And this was just an internal replacement. So the original portfolio manager is still with the firm. It was not a change away from him from a firm perspective. It was just for this specific fund. And the replacement had been previously a part of the portfolio management team. So he's a known quantity to investors into the fund, and we think that was an appropriate replacement for this event.
I noticed it's on the calendar. Excuse me, if I can continue.
Please continue, Mr. Treasurer.
It's on an action item later on.
Mm-hmm.
But you're still, even though with what you just said, you're still advocating for redemption.
So we are. The portfolio manager change was not the prime reason for that recommendation going on. And we can talk about that later or not, but there's other reasons that we believe that are being a little bit more proactive on that portfolio versus the portfolio manager change wasn't a significant event in our eyes to effectuate that.
It's really the inability of the fund to get to scale. They just haven't grown the fund, and that means we don't have a diversified portfolio of assets. And we'd rather be invested in a manager that has a large diversified portfolio of multifamily assets, which is the strategy for Berkshire. And so that's the thinking behind the redemption request.
Thank you, guys.
Thank you. Any other questions? Thank you all very much.
One more thing.
Oh,
yep.
I was dismissing you. Just
yeah, well,
Treasurer distracted me. I'm sorry, Paul. Proceed.
So you're not done with us yet. So real assets. So the real assets is a separate and distinct portfolio within the private asset class. So this
I'm going to step out. I don't mean to interrupt you, Seth, for just a minute. And so now our Peter Frank, the vice chair, since they can't see me leave, only can hear us leave, will chair the meeting until I get back, and I should be back in 10 minutes. Excuse me.
Thank you. So this portfolio, again, is approximately 12% of the total plan. It includes real assets and real return. We were specifically talking about the real assets portfolio here, which is about 10% of that 12. So the vast majority of it. But this includes investments across infrastructure, timber, agriculture, and energy, as well as sort of an other bucket, but mostly across those four asset classes. This portfolio is relatively new. So 2011, may seem 7-8 years ago, but it's still relatively new. There was one investment made then. But if you think about the nature of these funds, they are all 10-year plus vehicles. Some of them are much longer than that, 20 or even open-ended. So there's not a lot of history with this portfolio. But when we look about what we've invested in and how we've allocated this portfolio over time, so since 2011, we've committed $2.4 billion to 33 different funds, and that's across 18 different managers. So we've had a couple of repeat managers, and you'll hear from one of them today. But we think those strategies are appropriate to use the same manager. But 33 different fund investments have been approved since 2011. So significant amount of work by this group. Again, these are across those sectors that I mentioned. With the new commitments to the real estate debt sector that we recently approved for both Brookfield and Ares, that'll be included in this presentation as they start to draw capital and that capital starts to be invested. Those are really part of that real return bucket I referenced just a few minutes ago. So on slide 4, there's a lot. It's very. We're going to skip slide 4 and just kind of jump to slide 5 with the chart and the pacing chart here. It's slide 218, I believe, of your materials. We highlight the growth of the portfolio and the commitments made over the past 8 years. Very consistent investment pacing over the last 3 years, but much like a new portfolio, we sort of overweighted in some early vintages. We also committed to some open-ended vehicles early on to gain exposure. Approximately $300 million of annual commitments in the past couple of years, and looking for a little bit less than that going forward, but that number is pretty can change as we update our pacing models. The portfolio's funded allocation as of the third quarter, again, this is third quarter performance, was 6.2% versus that roughly 10% target within the portfolio. When we include unfunded commitments, so there are significant unfunded commitments in this portfolio because it's relatively new, we're at that 10.1% return, or 10.1% allocation. So about 36% of the portfolio today is unfunded. Much like real estate, it's above the target or much like real estate, this is above the target allocation on a funded and committed basis, but we need more capital committed in order to get there on a funded basis. And you'll hear from a manager today that will really satisfy our 2019 commitment. So you see here about $211 million of projected pacing for this portfolio. That is across those asset classes: infrastructure, energy, timber, and ag. We made one commitment late, again, 2018 to BlackRock in the energy sector. Today we're going to talk about Brookfield. Those two individually will combine for $200 million in commitments, so likely satisfy the numbers on your page today. But we are working with Vince and your team to update our pacing model. There may be room for another investment going forward. And we obviously are continuing to monitor the investment pipeline for new opportunities. On slide 6, we highlight the 1-year performance. Again, this is slide 219 in the book. And we show the different attributes of what's building up to that 1-year number of 7.1% return. Importantly, we show the 1-year number here. We'll probably next quarter start to look at the 3-year number, given that this is a longer life vehicle now. The 3-year number was a 9.2% return, just for reference. Given the strategy in this portfolio, we should spend more time focusing on sort of that long-term performance. But consistent with past quarters, both infrastructure and energy have and will continue to drive the performance of this portfolio. Those are the significant dollars invested. If you look at the chart there, it's over $500 million in infrastructure, over $430 in energy, and the other portfolios are a bit smaller. And portfolio construction was decidedly for those reasons. Really, the opportunity set in timber and agriculture is much smaller than energy and infrastructure.
On that note, that last bullet on page 6 there, Seth, it talks about variation in land values based on independent appraisals. That's just the valuation at the moment, not compared back to when we made the investment. We have a better valuation number now.
That is correct. So that is at the current value. So when we look at timber and ag, those are really relatively small changes in the portfolio. You'll see timber is slightly positive, agriculture slightly negative. When we look at the life, that's over the 1-year number. when we look at the life of those investments, the life of those vehicles, they're all right around a 1.011 equity multiple. So when we look at that equity multiple that Cecilia just described earlier, so they're all right at cost, more or less. And that's for a couple of reasons. One is there has been some fluctuation in valuation, so valuations have gone up and down. But a lot of that capital has been invested and not a lot of value has been created in some of those portfolios because it's newer, those are very long life vehicles. And the third reason is that there has been some economic impact to both timber and ag from an export standpoint. It's been a very difficult, those are two very difficult asset classes that haven't had the robust gains that we've seen elsewhere in the portfolio.
Thank you.
Mr. Chairman, what would be encompassed in other? What is that?
So there's only two investments in there, really, and they don't really just fit neatly into those buckets I described. So one of the investments, they invest in container ships. So it's technically infrastructure, but it's technically, it also includes maritime investments, and they also have a category of airplane shipping units of airplanes as well. So it's sort of it's an odd bucket that we just kind of a really small allocation to, but it just doesn't fit neatly into one of those other categories. So similar slides that we have in real estate. I won't go through each of these. I do want to touch on slide 16. I don't have the page number for your
slide 16.
16.
Okay.
And this is really the investment guidelines and compliance. And this is in the real estate
229.
Thank you, Peter. Chart performance as well. And really, we are constantly monitoring and making sure that we're in compliance with the portfolio policy statements. We are across the board here. The similar chart in real estate, there's checks across the board. You'll see the allocations here. They're smaller for agriculture and timber. The other is 0 to 15. But there is some manager concentration in the portfolio, as I mentioned. Just 18 managers with $2.4 billion. Nobody is near this 30% limit. We'll talk to one today that's a significant portion of your portfolio, but still significantly under this 30% limit. So nothing that concerns us, and really within policy, within allocation, in compliance for all of your portfolios. I'll stop here again and just open up to any questions.
Okay, are there any questions?
Actually, do we have any, in the debacle on Long Island City, Queens, do we have any exposure to Long Island City, Queens? I think it's almost as impactful in some ways as Brexit.
In our real estate portfolio, I think we've got something like 2,500 assets. I'd be shocked if we didn't have an asset somewhere in Long Island, Queens. But it won't move the needle for us, I'm sure.
Scott, go ahead.
This follows Tim's question earlier. It's on page 7 or 220 from our electronic books here. That the resignation of that Mr. Lubaugh triggered the key man event. I understand the decision that was made is described there. What was our full range of options that we had, given the fact that a key man? I don't remember a key man event being triggered before. What were all the range of options we had, given that occurred? So this we could have pulled right out, I would suspect.
Not necessarily. No. So let me describe the typical key man remedy.
Yeah.
Typically, if a key man event occurs, the manager has a period of time to replace that key person, and the investors have to approve that. If they do or don't approve, or if a replacement is not found, what ends up happening is actually the investment period expires at that date. So there's not a remedy to redeem or to pull your capital commitment, but the fund will no longer invest and then manage those investments going forward.
Seth, when you say investors, that's all investors, or is the investors committee?
It would be the limited partner advisory committee.
Okay.
Yes. Some votes are all LP-wide. Typically, in key man situations, it's simply the LPAC.
In this event, they had a number. So he was a key person that resigned. However, while it triggered an event, they quickly replaced him first. Second, that there had to be multiple members resign to leave in order to really trigger that investment period. Stopping that investment period.
Sometimes the key man event will say 2 of these 5 people, and so in this event, it didn't trigger the whole key man event. It was just his resignation.
And then, thank you. Importantly, and I know this answered the question, but the managers we invest with have very deep benches for this reason.
So, Tim, you have a question?
That's my question.
Okay, very good. All right, is there anything else then? Thank you very much.
We'll be back.
Thanks.
Thank you.
Next item on the agenda is market informational, and typically we take questions if you have them with respect to this resets and portfolios. Otherwise, we leave it to you to read. So are there any questions on the private equity quarterly performance?
Rolling on your fingers?
I have, seeing none, we're ready to move on, except I do have one
Mr. Chairman,
question.
I'm sorry, since it's the first time, really it's just not even a brief overview.
Sure, we can certainly do that. Who is going to be brief? David, okay. Brief, David.
Brief.
I mean, these are our New Mexico.
These are the New Mexico program.
Correct. We provide these every month. The first, starting on page 250 of diligence, is the co-investment report, the monitoring and reporting that Pavilion provides for the 5 co-investment funds. After that is, sorry, I'm trying to remember the order that I put these in. Then there are some color-coded pages outlining all of our national program private equity funds. The colors correspond to the quartile rankings, and you can get information on every single fund, in case you're curious about one. And then after that, and it's broken out by vintage year, by exposure, by NAV, so almost any way you want to look at it.
So maybe that was a little too brief.
Okay.
Are there any specific highlights? For example, the very significant turnaround in performance you might comment on with respect to our co-investment fund?
So I want to be cognizant of what I can actually say, but
yeah, don't forget.
But there have been some markups in the co-investment funds that have accounted for some significant performance, which you can see in the RBK reports and stuff like that for calendar 2018.
So also we have an item on the agenda coming up, I guess, change in the structure with respect to our private equity. I would like you all to consider the way we report with respect to the co-investment fund. If we're going to be treating them in a different manner, like just another manager in effect, I don't think it's appropriate to me to burden them with the record of the manager that they replaced. We don't do that with any other manager. If we get rid of a manager in public equity, bring on a new manager, we start reporting his or her performance from that date, and then the history is on the whole program. Right now, we keep getting these reports where we divide pre-2004 versus post-2004. It makes no sense to me because it's a different manager. So given that we're changing, I'd like you to consider that reporting. Maybe we can clean that up, deal with it as a historical factor for the whole program, but with respect to our looking at our co-investment partner, we should look at what they've been able to do since we've engaged them. Does that make sense?
On that, though.
Hold on. Okay, yeah, Lee, please.
Don't we have the same individual that was part of both groups? So you have, to some extent, the same key man. We're not transferring through that. So just because you change the organization, but you get the same investment professional there, I think there is some logic in continuing on. Maybe there were some changes in how he determined the business, but it's the same entity, basically.
Well, we can debate that at some point. I'm asking the staff to consider what's the appropriate approach. And yes, certainly there was a hangover from the old manager to the new program, totally new partnership, new entity, new approach. But we can look at that. That's a good point.
Yeah, well, I think.
Okay.
Maybe the council should weigh in on that discussion too as we go.
I'm sorry?
I say maybe the council as a whole should weigh in on that discussion too.
That's why I asked them to consider it.
And then the final reporting item is just by month, a list of transactions in the co-investment program and the regional program. So.
I'm just going to, if I can, just point out one thing that on page 253 that Linda and I were talking about is we've got the one company that's got a gross multiple of 9.28% on the top.
Yeah, be cautious on some of this is confidential.
Okay. But I didn't name the company. And most of the other companies are lackluster at best.
Yes.
So, you know, in terms of talk about the loss ratio we had before being 2/3 losses, one being a winner, we might exit some of these companies at a profit, but they really only have, you know, maybe 3 companies that you could consider have been solid investments for the state.
Right. Okay. I think we should turn to the investment committee report. Linda,
At the investment committee report, we always start with Vince's review of the current economic strategy and cycle, and that really sets the scene very well for what's going on with the State Investment Office in establishing an annual investment plan. And that annual investment plan is really the most important thing that we do each year, because as you have seen on the report from RBK, where they give attribution as to how our portfolio performed, the attribution is almost all to asset allocation. And that's going to be the root of our annual investment plan, is why we invest in what allocation we give. What is our perspective as to what the economy will be, what the various asset classes will do, and what will be the mix, and how that will suit our policy and our strategies. So that's going to be really important. So this is establishing what's going to be happening this summer when the annual investment plan is presented. So that's very important to us. Then we reviewed the investments and recommendations brought before you today. All members of the investment committee were present or on the phone, and all voted in favor unanimously, recommending the things that have been brought before the committee today. Thank you.
Okay. So I guess the first PIMCO is PIMCO. Mark.
Well, today we're bringing forward a $200 million commitment to the PIMCO Private Income Fund. I'll be providing a brief introduction, an overview, and this will be followed by a more detailed discussion from our consultant, Axia, and the fund manager, PIMCO. Today with us from Axia, we have Jennifer Wildman and Brian Goldberg, and from PIMCO, we have Michael Chandra and Jason Mandrek and Brent Gresham. The PIMCO Private Income Fund is a broad-based strategy covering investment categories of residential and commercial lending, specialty finance, and corporate lending. I wanted to highlight one of the pages from the PIMCO report to give you kind of an overview and a feel for how this fund operates. And so that is on the page 19 of the PIMCO presentation. It's 333 on diligent. So the fund is intentionally structured to be very flexible, so it can invest throughout the economic cycle. So what you see on the page entitled PIF Model Portfolio, under near-term outlook, you can see dials that are set very appropriately for the
investment environment that Vince mentioned earlier, kind of a late cycle economic environment, where you can see it's dialed down on the corporate lending and dialed up, for example, in specialty finance. Now, this fund is intended to invest throughout the cycle, and if you were to look at this, these dials in a bottom of a recession or at the early part of a economic upswing, you might see very different settings. So the PIMCO Private Income Fund will fit into the structured credit portion of the non-core fixed income portfolio. The fund is targeting 8 to 12% returns after fees. And the SIC has a long history of working with PIMCO, which we've detailed on the first page of the staff memo, which is page 294 in Diligent. And I just wanted to highlight there, when you look through the private credit funds that we've invested in the past, all have met a double-digit return on a net basis. And I also wanted to mention that Disco 2 and Bravo 2 are in the paydown phase of their cycle. So these will be rolling off, and we'll be left with Bravo 3 and potentially the private income fund in our relationship on the non-core side with PIMCO. At this point, I'd like to pass it over to Jennifer Wildman and Axia.
Thank you. I just want to give a brief background since a few of you I haven't met before. So I'm Jennifer Wildman. I'm a senior portfolio advisor with Axia. We've been working with the New Mexico State Investment Council for about 3 years now, initially transitioning over the fund of funds to the hedge fund direct portfolio, and then to the non-core portfolio following the liquidity study. Brian Goldberg here with me heads up he's a senior member of our research team, but he heads up our event-driven and credit strategies. So, you did a great job sort of presenting the recommendation with for PIMCO private income, but I just want to put it into a little bit of context with how we think of the non-core portfolio and the plan going forward, and also some of the comments that were brought today with what we're thinking in terms of the environment. For the non-core portfolio, we focused a great deal early on in the build out the core strategies. So these are the kind of strategies that we think of, as weathering the storm through positive environments, and will also protect in sort of the negative credit environments. We did a lot of work in the last year or so focusing on the other portion of it, which is the more opportunistic part of the strategy. So we brought to you some distress funds, some dislocation funds. We had some contingent vehicles also, and those vehicles were positioned more to kind of take advantage of the opportunity should a distress cycle come about, should we have some dislocation in the credit market. Some of the things that I think we sort of think are on the horizon, though we've thought that for many years, and so we don't necessarily know the timing, but we wanted to be prepared for that. But we do think it's important also, since we're not sure of the time, to get back to the core. So PIMCO private income is something that we're thinking of for that core. It's something that we think can be much more opportunistic, much more tactical. These are funds that, if we were to try to be more tactical, it takes a good deal amount of time to get invested and bring before the committee, and so you don't necessarily have the flexibility, but the funds themselves do. And so one of the reasons that we chose PIMCO, obviously, was the long-standing relationship. We've had some great experience with them. You have, a number of funds already invested with them, even in the non-core fixed income portfolio. And number two is the breadth of their platform. So they do have a number of products and strategies on their platform, and so we think they're well equipped and in a good position to be more tactical and to take advantage of that and sort of move the portfolio where they see the opportunity set. So I don't want to take too much time, so maybe we'll just get directly into the recommendation and go into some detail about PIMCO.
Sure. Thanks, Jen. Good morning, everybody.
PIMCO, as you know, is a large asset management organization with about 1.7 trillion in AUM. Just over 20 billion of that is in what they call the Alternative Credit and Private Strategies Group, and that includes some of the funds that you're familiar with, like Bravo and Disco. And that's a growing part of their business that they've committed a lot of resources to that we're familiar with. The Private Income Fund is a new launch for PIMCO. They're targeting $1 billion raise. It focuses on generating income from performing private credit assets across 4 verticals. So it's residential, commercial, specialty finance, and corporates. And they're going to use a moderate amount of leverage to get there, to get to that 8 to 12% target return. We like the diverse mix of underlying assets and certainly the potential for a diverse portfolio here. On the residential side, that could include newly originated mortgages, seasoned loans, servicing rights. Within specialty finance, that could be consumer loans, small business loans, student or auto loans, some aircraft or railcar finance. Within commercial real estate, it could do senior or mezz lending, could do some land banking or development lending. And within corporates, it can do direct lending, DIP financing, or other asset-based lending, although like Bart said, we expect corporates to play a smaller role in the fund, at least initially, given the outlook at the current moment. Manager takes a relative value approach, which we like, so the mix of those assets can change depending on the current opportunity set and the changes in the economic cycle. We think the fund fits nicely onto the PIMCO platform, uses many of the same resources and team members that other successful PIMCO products use. But it's differentiated in the sense that the manager's finding opportunities that don't fit the mandates for some of its other products, and so it's launched this fund around those opportunities. The team working on behalf of the fund, some of the most senior members of the PIMCO organization, and they have the support of over 100 investment professionals, as well as the resources of the broader organization. That includes different sourcing channels. Some of them are proprietary, but some of them are just unique ways to access opportunities in the market. To round things out, we like to highlight just the risks or potential issues that we see. And so I'll mention a few things. The first is that the team is not dedicated to this product. It works on a number of different products at PIMCO, and they're not directly compensated by the results of this fund. Usually we like to see it the other way around, but like we said, we have a good deal of confidence in this team. We've seen the manager be successful under that compensation and alignment scheme in its other products, and so we think that is sort of a good mitigant to that dynamic. The second is this is the first time fund launch, so there's no track record really to go off of, but again, having thoroughly reviewed the capabilities of the organization and knowing the team members, we don't view that as an insurmountable hurdle. Third, the use of leverage. Leverage, as we all know, can magnify the impact of any investment decision. That's where we think the manager's underwriting and due diligence comes into play, but we just like to point out that there is leverage in the fund, or there will be leverage in the fund. And then fourth, it's not so much a risk as it is a feature of the fund, is that if investors redeem, because of the nature of the underlying assets, you aren't paid out immediately in cash. What happens is a slice of your portfolio is sectioned off, and as it gets liquidated, your proceeds are paid back to you. We actually think that protects the investors that remain in the fund, so it's a good structure. This is an evergreen structure. And what's good about the feature is that performance fees are not charged until all of those assets are realized. And so we think that aligns the manager and the investors well. So all that said, we have a favorable view of PIMCO. We think that this product has great potential, and we think the manager is in a great position to execute on the strategy. So I can leave it open to questions, or we can hand it over to the folks.
From PIMCO, and then we'll cover some questions.
Sure.
Thank you. Good morning, Mike Chandra. I oversee PIMCO's public client practice, but more relevant for today's discussion, I've had the pleasure of working with the State Investment Council since the inception of our relationship back in 2011. So let me first say thank you. It is a multifaceted partnership that we've had over those 8 years, and I think very germane to the conversation earlier, it began on the core side of your fixed income book, but pretty quickly expanded to include some non-core fixed income strategies, Disco 2 being one that we've talked about before. I think that one is actually pretty illustrative of why non-core is still interesting today. When I was in front of you 8 years ago presenting on DISCO 2, we thought that investment could deliver 10 to 12% net returns with a life of, call it, 2 to 3 years. Here we are 8 years later. It's had a return over 13% and still performing quite well. In 2018, for instance, in an environment where equities were down, core bonds were down, DISCO was up close to 6% net of all fees. And so, where we're finding value in fixed income markets is where there's an imbalance between the supply of capital and the demand for capital. And how can we figure out a way to provide financing to markets that need it? And before we jump into the private income strategy, I'd actually like to do something unconventional and compliment one of your other managers, one of our competitors in the space. Last time I was in front of the council, David Golub and Axia made a very compelling presentation on the attractiveness of the corporate direct lending market. So basically providing debt financing to private equity buyouts. That investment idea makes a lot of sense. It's do what the banks can't do, generate stable income, very good risk-adjusted returns. It's easy to understand, and for that reason, Golub has done very well. That part of the market has been the most in-demand area within the private credit markets, corporate direct lending. Popularity is nice if you're a high school student, but if you're in investment markets, popularity means that certain areas can get crowded. And we think very highly of Golub. We think they can continue to deliver strong returns. But when we were looking at markets that we thought could provide similar characteristics to corporate direct lending, but have less crowdedness in them, was really the genesis of the private income strategy, which my colleague Jason Mandanak has been integral in formulating. So with that, maybe I'll turn it over to Jason to provide a little more comments.
Great. Thanks, Mike, and thank you all for taking the time. I'm Jason Mandanak. I'm an alternative credit strategist at PIMCO and focus on our private income strategy. I'll start off on page 18 of the deck in kind of backtracking from Bart's comments. I think that's page 332 of your other deck. It's the title Proposed Private Income Fund, Opportunistic, Integrated, and Evergreen. And in the interest of not being repetitive to some of the other comments that others made, I think there are a couple key points, and I would start out with just the context for why we are launching this. Private credit has grown as an asset class, as I think you are quite familiar with. One of the things that we've noticed, and we've noticed in partnership with New Mexico SIC, is that oftentimes private credit has been defined as middle market corporate lending. But as this asset class has grown, as it's playing a larger and more structural role in client portfolios than ever before, we really felt, and Bart and the rest of the team, I think, agreed, that a broad-based solution to private credit made a lot of sense. And when we say broad-based, to echo what Bart said, 4 key verticals: residential lending, commercial real estate lending, corporate lending, and specialty finance markets. And that's really what we mean when we say opportunistic approach to private credit. We're really excited about this because we actually think it's very unique relative to other private credit offerings for a few key reasons. The first is that opportunistic and flexible approach, where today we want to focus on areas of the economy that have re-levered at a slower pace than others because we are a decade into the recovery. But we also want to be able to pivot when some of those sectors stumble and when there is better compensation for risk to be a lender in those markets. The second thing is the evergreen structure. As private credit has grown, the vehicles have not adapted, meaning it still is a lot of vintage drawdown vehicles where your capital is called for a period of time, you get distributions, and it puts a lot of operational burden on investors in that you're constantly re-underwriting new strategies, trying to look at relative value across middle market corporate lending versus commercial real estate lending versus specialty finance, et cetera. We think that this can really be a flexible solution in an evergreen structure that allows you to have a more structural allocation to private credit, but do so with enough investment flexibility to navigate cycles. And the last point I'll make on this page is just the integrated investment team. We think that one of PIMCO's key competitive advantages in this space, quite frankly, is the integration of our investment team. We're not going to sit here and tell you that we are better at middle market lending than a Golub or an Ares. We're not. I think where we really do excel is in looking across a variety of different credit verticals, looking at relative value and putting together diversified portfolios, leveraging the fact that our portfolio management team has grown largely organically with some select external hires, governed by one investment committee, and able to leverage the infrastructure, the macroeconomic process, the risk management process that PIMCO's delivered for decades. And so that's really what I'd say we're most excited about. On page 16, to kind of jump around a bit, I just want to put a little bit of a visual to Mike's comments on the corporate space, and this is a simple visual, but really what you're looking at is middle market direct lending yields relative to leverage. And what you've seen is that this sector was extremely attractive, and not that it's sorry, page 16. I think it would be 330. Robust capital formation has created froth in the middle market. And this doesn't mean that every corporate lending strategy is bad by any stretch of the imagination. All it means is that people typically, when they want private credit, why do they want private credit? Typically because it's better risk-adjusted returns versus public credit, or it's a de-risking tool relative to equities, and that's typically because it's less crowded. Now you've seen a tremendous amount of capital formation from institutional investors via direct lending funds. You've seen a tremendous amount of capital formation from retail investors via business development companies or BDCs. And you've seen a lot of capital formation via the capital markets through collateralized loan obligations or CLOs. And so because of this, you've seen leverage levels increase, lending standards deteriorate, and yields, generally speaking, come down outside of the fourth quarter of 2018. We go to page 11 next, and that's PIMCO's private credit platform highlights. That should be 325, I believe. And just to give a bit more color on the four main verticals. One, Brian noted that we don't have a specific track record to work off of. This is a first-time fund. I want to be very clear that none of these assets are first-time assets for PIMCO. We have a long-standing footprint in private credit markets, and it's actually a lot larger than I think people realize. So I'll go through each vertical and just talk about, one, our presence, and two, where we'd rank it on a relative value basis. First is residential mortgages. It's probably our highest conviction area of the economy. It doesn't mean the housing market's booming. What it does mean is that we think the housing market is more resilient than other forms of credit to own at this stage of the cycle. The average American has about 40% equity in their home. Unemployment is at well over a decade lows. Wage growth is starting to improve, and the U.S. consumer is on fairly firm footing. That all bodes well for housing, not to mention some of the supply-demand dynamics that were spoken about earlier on the real estate side are even more true where there's not a lot of homes being built in much of the country. Here we've deployed about $62 billion of capital into the private residential loan markets since 2010. So that's an area that we continue to find a ton of value in. Next would be commercial real estate debt. And here, while we're constructive, we're not nearly as overweight as we would be to residential. The reason for that is that commercial real estate prices have rallied at a faster pace than residential post-crisis, and that there's been a bit more competition on the lending side. There's a lot more lending vehicles. There's mortgage REITs that are active in the space. And so here we really do want to pick our spots. We've deployed about $9 billion in private markets on the commercial real estate side across debt and equity. And really where we're focused today is in larger transitional loans in primary cities outside of central business districts. And most of these are 3 to 5 year type loans, floating rate assets, so not much interest rate risk, senior in the capital structure, and what we feel will be quite resilient even into another downturn. Third would be specialty finance. This is a term that's thrown around a lot. When we talk about it, we typically mean non-bank lending that falls outside of the two main verticals of mortgage and real estate related and corporate related. And so to Brian's point, that could be things like consumer lending, auto lending, student lending on the consumer related side. And then there's a commercial market as well, which can be small business lending, can be equipment finance, aircraft finance, and all forms of other receivables, trade receivables, and things like that. That's a market that we also like. I would say there we don't like everything. We're probably most constructive on the U.S. consumer. That's one of the kind of linkages to our view on residential real estate. But we continue to be quite active in the consumer lending space. Last is corporate credit. There we've deployed about $10 billion in private corporate financing since 2012. To Brian's point, we're going to de-emphasize that right now. There's not a lot to do given how much capital has been raised in that space. Generally speaking, there's going to be one-off opportunities here and there, but we're really going to pick our spots and wait for better entry points in that market. With that, I will kind of just skip around to the terms on page 37. And I've lost track of what that would be in
Go ahead, Rob.
37 would be 351.
351, thank you. And I'm not going to go through every term, but I do think that there are a couple things to note. First, we're targeting $1 billion in the initial capital raise through founder share classes, $500 million for Series A, $500 million for Series B. It's an evergreen fund with a 2-year hard lockup and redemption features that Brian alluded to. The management fee is 125 basis points. The incentive fee is 12.5% over a 5% hurdle. The founder share classes, the Series A is 50 basis points off that management fee, so 75 basis points. Series B is 25 basis points off, so 100 basis points. Given the strength of the partnership and the size of your investment, this would be the largest and best terms that we would be offering to any client. And that would be 60-40 at a minimum between Series A and B for the full $200 million. And that would also qualify for the incentive fee discount from 12.5% to 10%. There's one other thing I want to highlight that is not shown on this term page that I think is quite important. Because this is a multi-sector strategy, there's an additional benefit in that you're getting the netting of fees across a variety of different strategies. Whereas if you were putting together a diversified private credit portfolio and you had a commercial real estate manager, a specialty finance manager, and a residential mortgage manager, and the residential mortgage manager knocked it out of the park and the other two lost money, you're still paying significant performance fees to the residential manager regardless of what these managers did. Because this is all under one umbrella, governed by one manager in one fund, there's a netting benefit that I think is great incentive alignment long term. Yes?
Crystallize annually. You explain what that term means.
So while you are invested in the fund, we would annually crystallize the incentive fee. So every year, we would look at where's our performance relative to that hurdle, and crystallize, meaning we would collect our incentive fee over that hurdle.
So it's not cumulative.
On the redemption, it becomes cumulative because then the incentive alignment needs to be aligned where we want to get you your money back as quickly as possible. It's not in our incentive to drag that out for an extended period of time. And that's standard for these types of evergreen vehicles.
Any other questions? Yes, Scott.
Your page 32, R346, I was curious that mortgage servicing rates.
Yes.
Is that in simple terms like escrow, making sure the escrow, I didn't think it was. But
so it's basically the right to service a mortgage. So what a mortgage servicer does is essentially in a performing world, collects principal and interest payments and passes them through to investors. In a distressed world, they will modify loans to get borrowers back on track or initiate a foreclosure. What a mortgage servicing right essentially is it's a unique private credit asset that is the right to service a mortgage. And so you're getting that income stream. And so let's say I took out a mortgage, there's a 25 basis point servicing fee. That would be paid to the manager. And so it's kind of a unique private credit asset that we don't expect to be a significant portion of this fund. But the reason it's unique is that as interest rates rise, its value typically rises because you're getting that interest payment for a longer period of time because people are less likely to refinance.
Thank you for that.
No problem.
Anybody else, Mr. Treasurer?
Thank you, Governor. Would you go to page 51
Absolutely.
and kind of walk this country guy through that a little bit more, especially how it works, because I haven't figured out if most of this is in illiquid exposure, how you're going to provide us with 90 days notification.
Yep. That's a great question.
Distribution.
And it's key to doing this responsibly, quite frankly.
So start at the beginning and I apologize to you, Governor, and members of the board, but walk me through this.
Absolutely. So the fund is a 2-year hard lockup with annual liquidity thereafter. That annual liquidity requires a 90-day redemption notice, to your point. Now, I think that the simplest way to explain this is, let's take an example of all of us in the room are invested in the fund. And in 3 years, I decide to redeem. I put in my redemption. The only way to really offer private credit in an evergreen vehicle is to remove the asset liability mismatch. These are less liquid assets in an evergreen vehicle that has redemption terms. So what happens to my redemption is nothing, essentially. The manager doesn't change the way that they manage the portfolio. My redemption is basically cut off. And as assets mature, or as PIMCO sells something, I get paid back. It doesn't mean that we change the way that we invest the fund or sell assets, which would not be in the interest of the rest of you, because you're investing in it specifically for that income and the higher return. And that's really how it works. And so that's the slow pay structure. So every year there's an option to redeem. If you redeem, you go into a slow pay structure. If the fund's sitting on any cash at that time of redemption, you may get a portion of cash at that time. Everything else we would expect to be roughly a 3-year weighted average life from the time of redemption to the time you get paid back.
Okay. Anyone else? We're just trying to figure out who's in charge.
Yeah, I know who's in charge.
I know we're not.
Thank you for helping me do that. All right, any other questions? Yes.
Are we ready for a motion?
I think we are. Is there any other discussion or questions? Thank you for moving us right along. We are ready for a motion, and so based on the recommendations of the Council Investment Committee, I am hoping that you're about to.
Based on the recommendations of the Council Investment Committee, Fixed Income Advisor Axia, SIC staff, and the General Fiduciary Oversight of RBK, I move that the State Investment Council approve up to a $200 million commitment to PIMCO Private Equity Income Fund, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Any discussion? All those in favor?
Aye.
All those opposed? Anybody abstain? Motion carries. Thank you.
Thank you.
Thank you very much.
Got it. All right, we're on item 3C, private equity. Smith, David Lee, developer. TA fund. Proceed.
All right. TA Fund 13 starts on diligent page 382. It's formatted in our typical way with about a 6-page staff memo, followed by a deal recommendation that's provided by Pavilion. And then we also provide a presentation from TA Associates talking about their performance, talking about their organization. So with me, I have, as you know from before, Alan Waldrop and Richard Pugmire from Pavilion, and also Ashu Agrawal from TA Associates. I'll just make some introductory comments and then turn it over to Pavilion for some more comments, and then we'll turn it over to Ashu to talk about TA. TA Fund 13 is a global growth and buyout strategy. It's focused on the middle market. What does that mean? Investment check sizes will average between 125 and 150 million, with probably a range of 75 million to 400 million. Geographically, TA's investments will be mainly in the U.S. and Canada. It's a target of 60 to 70%. Europe has a target of 25 to 35%, and then also some exposure to Asia, 5 to 15%. Fund 13 will have approximately 60 companies, so it's a very diversified strategy. The target sectors for this fund are technology, which historically has drawn 36% of the capital, financial services, business services, which has historically drawn about 34%, healthcare 14%, and consumer with 16%. The size of the fund, the target is $7.5 billion. The hard cap on that is $8.5 billion. And just for perspective, Fund 12 was 5.3 billion, and Fund 10 was 4 billion. As a firm, TA is one of the oldest private equity firms and became an independent partnership in 1977. TA is well known for its extensive sourcing and origination capabilities. We consider this to be one of their main competitive advantages. The firm currently has 168 employees, including almost 90 investment professionals, and they're located in 5 offices globally in Menlo Park, Boston, London, Mumbai, and Hong Kong. The firm also continues to add and grow resources. For instance, at the vice president level and above, there were 33 investment professionals in 2014. They're up to 44. They've also continued to add to the Strategic Resource Group, which is their consulting arm that they use to augment growth at their portfolio companies. That's up to 9 employees. And in 2013, they added a capital markets group to help with realizations and recaps. In terms of fund performance, performance has been very strong. 3 of the last 4 funds are at least a 20% plus net IRR and a 2.25 times net multiple. That doesn't include Fund 12 because Fund 12 is too recent. Fund 10 is the laggard. And 4 of the last 5 funds have been first quartile, or the top quartile. And as of 9/30/18, our last performance numbers, the net IRR on all TA equity funds is 20% over the last 20 years. So a very impressive track record. TA also continues to do a great job of returning capital, which is important to us. 4 of the last 5 funds rank in the first quartile for distributions to paid-in capital. So they're obviously doing a good job selling their companies. And currently, the New Mexico State Investment Council has a $100 million commitment to TA12. That's the only active fund that is currently at a 31% net IRR and a 1.37 times net multiple. But in the past, we've had smaller commitments to Fund 9, a $10 million commitment, which is a vintage year 2000, and Fund 8, a $1.25 million commitment, vintage year 1997. We are recommending up to a $100 million commitment in TA13, and this would be the first commitment of calendar year 2019. And with that, I will turn it over to Bill.
Thanks, David. David did a great job talking about the merits, so I'll just hit on some of the risks. If you look at our investment recommendation, we always kind of list the merits and then we list the risks as well as any mitigating factors that come from our analysis. And you're always going to see risks with every investment that we bring in front of the council. Some of the ones we highlighted is the firm's annual investment pace increase. What's interesting, though, is TA is actually using the favorable environment to sell a lot of their companies. And in your commitment, even though it is still fairly recent, you've already gotten paid back 25% of the contributions that you've given. We also talk about the underperformance of TA10. What's great, one of the things I love about TA is they continually improve and seek to improve. They don't just blame the market environment for the performance of TA. They look at their investment processes and how they can improve over time. We also looked at the team's capacity in light of raising a larger fund, and also they're increasing the number of companies. But they continue to increase their team. They have a large senior team as well, a really deep bench of people to rely on. And then also they also manage captive debt funds, which will also invest in the TA portfolio companies, usually at the same time that the investment's made. They have procedures in place to reduce those conflicts, and if there is a conflict that can't be resolved, they go to the Limited Partner Advisory Committee for that, and we looked at some examples of that. One note about terms, too. TA has historically been able to receive premium terms. You heard the track record. But over the last few funds, there has been improvements to bring the terms more in line with market terms. Also, the other thing we really like about TA is the size of their commitment from the team to this fund. It's one of the largest we see in the market. And that just shows that they continue to invest in themselves, which is very strong alignment. We're recommending a $100 million commitment, which is at the high end of what we typically do. We like the TAs diversified. It'll also help further diversify the private equity portfolio, as TA is not one of the largest manager relationships or largest fund relationships right now, so that'll further diversify that as well. I want to introduce Ashu Agrawal, who's a managing director in the technology group at TA. He's based in Menlo Park. He's been with TA for 8 years. He's a member of both the core investment committee, which oversees the investment process, and then the portfolio committee, which oversees companies post-investment as well. So we're going to turn it over to him for a short presentation.
Thank you very much for taking the time today and your support over the years. We really appreciate it. You know, as we like to say as partners, we really know who we work for, and we work for all of you and the constituents that the capital represents, and we never lose sight of that. So with that, I'll turn over to slide 6 on my deck. I don't know. 469. Which is just, I'll cover a few slides providing an overview of TA, and then we'll take questions because there are a number of slides and we don't need to go through all of the slides. So slide 6, as it was mentioned earlier, the firm was founded in 1968, which makes us one of the older private equity firms in the business. Over the last 51 years, the firm has had an attractive track record. The 3-year net IRR is 24%, 5-year 23%, and 20-year almost 20%, and then 27% over the last 25 years. We have 5 offices globally, as David mentioned. I'm in our Menlo Park office. Boston is our headquarters, and we have opened 3 offices internationally over the last 20 years in London, Mumbai, and Hong Kong. Relatively, about 65% of our investments in the last 5 years have been in North America, 25% in Europe, and 10% in Asia. Slide 7, this is really, we have always had targeted alignment with our investors, and this goes through some of the areas. The first is our core values and culture. Our firm has always been built upon transparency, both internally and externally. Hopefully, your colleagues here who see some of our reports see that. We believe in the philosophy, good news, bad news, everything travels as fast as it can, and so we try to be very transparent with you. We know we are in a cyclical business. Markets go up and down, our portfolios go up and down, but what we can do is be communicative and make sure everybody is fully aligned with how we are thinking about the strategy that we are investing behind, and our limited partners are supporting us on that. We are a fully private partnership. 100% of the firm is owned by the managing directors of the company. This has been through since inception. And we have a process by which the ownership of the firm transitions over time. As you will see, the private equity industry, one of the things that causes private equity firms to not last as long as we have is ownership transitions. A few people found the firm, and then over time, there is no set mechanism for ownership transfer, and so therefore the younger generation that comes up, they're not able to get ownership in the firm, and they leave and form new funds. TA, because of people who preceded me, frankly, created a structure whereby there's a retirement process and an ownership transition process that really helps create longevity of the firm. The ownership amongst the partners is very diversified. No single partner owns more than 6-7% of the firm at any given time, and also the performance across the partners. We're 24 MDs. If you look at the performance across partners, it's very well distributed and in terms of realized gains. The next one is the meritocratic ownership structure, which I talked about. It's really our ownership in the firm is tied to our realized gains, and it keeps changing every year, so there's no set. It's a formula that is used to determine how much ownership a partner has in the firm based on their track record and performance within the funds. The team has been very stable by virtue of this process, and then we are in one business, which is we want to invest in growing and profitable companies, and over time we have stayed focused on that. We're not. There was some discussion earlier about venture capital. We're not in the venture capital business. At the same time, we're not in the extremely late stage turnaround business. We just want to invest in good, growing, and profitable businesses, and that's where we stay. And as was mentioned, TA is the largest owner GP in the fund. So, any questions from that?
Any questions? I think so. We're done? So we would entertain, I believe, a motion. Linda?
Based on the recommendations of the Council Investment Committee, Private Equity Advisor Pavilion, SIC staff, and the general fiduciary oversight of RBK, I move that the State Investment Council approve up to a $100 million commitment to TA13 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second. Any discussion? All those in favor of the motion signify by voting aye. Aye. Any opposed? Any abstain? The motion carries. Thank you, gentlemen.
Thank you.
All right, we are on item 3D. Brookfield infrastructure.
Be good. Chris? Ben, sorry I got your name spelled wrong there. No problem. Oh, you got it. We're good. Good morning again. We're here to discuss a commitment of $100 million to Brookfield Infrastructure Fund 4. I think we'll all be very brief here. We have a long relationship with Brookfield. This will be their third infrastructure. We're investing with them. We're also in an ag fund of theirs, a timber fund, a real estate or two real estate debt funds. So it's a very deep relationship that we have with Brookfield. We like their performance historically. The BIF 2 and 3 funds have performed very well. One of the things we like about the infrastructure space is the high cash yields, and BIF 2 and 3 have been very strong in that department as well. So rather than hang things up here, I think I'll turn it over to you, Seth.
Okay. So again, I'll keep this brief too. Maybe just elaborate a little bit on the portfolio construction conversation around this commitment within the portfolio. So Townsend's infrastructure efforts briefly just really addressing the portfolio construction. So this will be the 9th infrastructure investment within the portfolio. Again, the third commitment to Brookfield. So there are 6 managers out of those 9 commitments within the infrastructure portfolio. As outlined in our memo, the real assets portfolio, this would represent the 6th fund commitment to Brookfield, as Paul mentioned. There are infrastructure, multiple investments, timber, ag, as well as energy. So from a portfolio exposure standpoint, Brookfield will represent approximately 15.8% of the total real assets portfolio if all capital was drawn today. So there's a 4-year investment period here that's not going to occur, but looking at the worst case scenario, I guess not the highest exposure scenario would be 15.8%, well below our 30% limit. Additionally, we became very comfortable with this, Townsend as well as staff, given that exposure is across multiple sectors. So it's not just within the infrastructure sector, it's real estate, timber, ag, energy, and infrastructure. From an investment pacing perspective, this is approximately $200 million to commit to the 2019 vintage. As I mentioned during the real assets portfolio update, we did make a prior commitment to BlackRock for $100 million. This was made in October and counted towards the 2019 allocation. And then this commitment today, if approved, would represent the majority, if not all, of the commitments made to the real assets portfolio of this vintage. Again, we are working and updating our pacing models to verify that number is correct. There may be some additional room. With that said, we do continue to evaluate other opportunities. Could be in front of you later on this year with other investment opportunities or portfolio rebalancing. Quickly on the fund, so Brookfield is targeting a $17 billion fund, broadly diversified by sector, geography, really focused on acquiring high-quality infrastructure assets and asset-backed companies, really core infrastructure assets and sectors. Fund targets a gross return of 13%, a net equity multiple of around 2 times your equity. It also comes with a cash yield. Will be lower in the beginning as the portfolio grows, but over time grow to approximately half of that total return. Brookfield generally does target longer hold periods, so we'll see a little bit of a lower IRR in this portfolio versus in a higher equity multiple. That's part of the strategy going in and something that they can elaborate on. But acquisitions really focus on core infrastructure sectors with assets that have a high value-add risk profile. So the value-add risk profile still means that Brookfield will focus on brownfield existing operating assets, but typically with higher growth potential, so some capital structure optimization as well as opportunities to increase earnings through operational improvements and CapEx. They will or could consider greenfield investments as well, approximately 10 to 15% of the fund. These are more opportunistic in nature, but they really will deploy this capital with key risks being mitigated. So cost of completions, cost overruns, uncontracted revenue will be very mitigated if these investments are made. There are a number of pros, potential issues and concerns outlined in our memo. I'm not going to go through each of those or any of them unless you have any specific questions. But at this point, I'll just hand it over to the Brookfield team to really present their investment.
Great. Thank you. Madam Governor, members of the council, there's a lot of familiar faces. I've been fortunate to be involved for about the last 10 years. I'm with Ben Vaughn, a senior management partner. For me, it's a great excuse to get out of Arizona and get some out of Sonoran Mexican food and into New Mexican food. But I would take maybe 30 seconds for the newer members just to give you a quick background on Brookfield. One of the largest real asset managers in the world, about $350 billion of assets under management. But what I would tell you is our success is being involved on the ground. We are very operationally oriented. And to that theme, we have about $500 million of assets in New Mexico. We consider ourselves a citizen of New Mexico, including Coronado Center, which we're doing a huge redevelopment of, and even some solar assets here in Santa Fe. So, we believe that you have to be on the ground and be a citizen and take an active role in managing these assets. We're not a financial investor at all. So with that, I'm going to pass it to Ben. Ben's been with the firm almost 20 years as a senior managing partner and one of the 3 lead investors for this strategy.
Yeah, thanks, Chris. And I'll be pretty brief. I came down from Canada last night, so I wanted to thank everyone for the snow on the ground. When I arrived, it feels like home. So thanks for that.
It's balmy here. It's 30-some degrees this morning. It was only 12 degrees yesterday morning, so we're trying to help you.
Yeah, so I'll appreciate it.
Well, we've heated them up with some chili.
Can't drink enough milk after all that. So, look, as Chris mentioned, I think I'll just start off. At a Brookfield level, one of the things that we pride ourselves on is we are one of the largest investors in all of our funds. So we're usually somewhere between 25 to 35% of the capital in every fund that we raise. So we are principals and eat all of our own cooking as we invest. The firm has been around since the turn of the last century, since the 1890s, and for most of our history we were owner-operators. It's probably since about the late 1990s that we became an asset manager and started to raise funds from private investors as well as deploy our own capital. And with that, I'll just walk quickly through our infrastructure group and touch a bit on our strategy and how we get the types of assets we're looking for and how we get at them and acquire them and run them. So today we have 200 investment professionals across 17 countries. So as was mentioned before, we're looking to build optionality both geographically and in terms of sectors so that we can deploy capital for value. We're targeting 13+% returns on assets that are very core of the core infrastructure. And in order to do that, we generally need to go where capital is scarce in any given moment or to sectors which may have fallen out of favor or, as was mentioned, get involved in multifaceted type transactions, so either financial restructurings or operational turnarounds, those types of things, to generate the kinds of returns that we're targeting. We have 31,000 employees in all of our various companies worldwide right now. And I'm on page 5 of our deck. I apologize.
Page 657.
But I'm on the page with the map.
It's about 565, give or take,
for what it's worth. And you can see from the map, the bulk of our assets are in North America. So about 40% of our businesses are in North America. We have about a third in South America and the rest in Europe, and a growing presence in Asia Pacific, although modest and growing. The sectors we target are transportation. So predominantly today, the portfolio is made up of railroads and toll road operations. We also have significant container port operations. And we like that sector because generally you get long-term cash flows with some benefit as volumes grow or as GDP continues to grow. We're a large player in renewable power, and we've been investing in renewable power for over 25 years. We're one of the largest owners of hydroelectric plants that are not owned by government-owned utilities. and we're invested in wind, solar, and battery storage as well. So we're pretty excited about that space and have been consistently able to deploy capital over many decades in renewables. We have a good utilities franchise. This is the most boring part of our business, and it should be. These businesses should be very reliable and stable. I don't have many other comments there other than many of our utilities are called on to grow by the regulators and by the stakeholders in the communities in which they exist, and so we're very keen on always looking for utilities with a bit of a growth profile. On the energy side, we have large pipeline networks, gas storage systems, and residential type assets like water heating systems. And we see, I'd say if I had to make one comment about North America, we're pretty excited about the energy space in North America today. The capital markets have turned down a little bit their excitement about energy infrastructure at a time when North America needs more of it. So this is a very active space for us today. And probably the newest, I'll call it leg on the stool for us in terms of investable assets is data. So today we have investments in towers, so telecommunication towers and fiber networks. And it feels like it's relatively early days in this sector, but 20 to 30 years from now, we think data will have fully emerged as a very middle of the fairway core infrastructure holding for many portfolios. So we're being very measured and cautious about how we're approaching this space because it is relatively new and seeking only contracted type assets. But it's a pretty exciting area and one that we would expect to deploy some capital in the current fund. And with that, I'll just conclude by saying that we look for assets, I think as was mentioned, that are very stable in their profile and generate cash. These assets should produce a 5 to 7% dividend yield pretty much out of the gate, and all three of our vintage funds are operating at or above that level. So as was mentioned before, in some of the dynamics around what could happen with the vicissitudes in the capital markets, these are the types of assets that have low risk profiles. They have very long dated contracts or regulatory regimes. And in addition to that, you can get very long dated financing, investment grade financing on them. And we always look to push out our maturities to make sure we don't have any near term refinancing issues, so that these portfolios should be able to withstand all of the movements in the capital markets that happen over a cycle. And with that, I'll conclude my remarks and happy to take questions.
All right, thank you. Are there any questions? Yes, Senator Russell.
Yeah, Madam Chair, I just get back to Chris, but based on our long-term relationship and your desire to grow the transportation, particularly the rail sector, I just wondered if you're going to take the rail runner in trade.
I don't know enough about that to comment.
It's a pretty good deal. It's a pretty good deal.
Perfect. We like good deal. Is it a contrary?
It's me to recognize the senator.
Well, we should keep it on the table. You should look into it.
Noted. Thank you.
Yeah, we have a few more questions. Senator Jennings.
Do you have any avenues for liquid natural gas or transportation natural gas, where they liquefy it?
Yeah, so
send it out?
Yeah, we have a number of investments in and around enabling the pipelines that go to and from large LNG facilities. To date, we have no investments directly in LNG facilities. I think it could happen over time that once facilities are built and de-risked and commissioned and operating and have a track record, they could become infrastructure-like and we could look at them. But at this point, we have none, although we do own significant infrastructure in and around some of the existing ones, especially here in North America.
We could use a few more
Yes.
here. North of the railroad, we can go ahead and give you another right away.
Yeah. One observation I would make is there are more needed here, and there are many import facilities getting built, especially in the emerging markets. So the market is ready for gas from North America to flow to emerging markets.
And we do have some of that exposure through our other managers, LNG exposure.
Mr. Treasurer?
Thank you, Governor. I don't know if this is a question for Chris or Ben or maybe for you from Townsend, but looking at page 228, that's going way back in we've got 2, 4, 5 different investments that you show here with Brookfield, but on 3 of them you didn't take all of the assets. I mean, still uncommitted.
Yep.
Literally half in some cases.
Yeah. Ben, you want
me to
Those are from 2013, 2016.
Yeah, so we had 2 strategies, specifically in timber and ag. So we've been able to deploy all the capital in our infrastructure strategies. But in timber and ag specifically, we thought probably about 15 years ago now that those would be large, deep, investable universes that would develop over time. And they turned out, in our view, to be very niche, rather smaller investable universes, and we struggled to deploy capital on a good risk-adjusted basis. In our view, there was a lot of capital chasing few opportunities, and so we have we did not deploy the capital from those funds. I believe one of them's closed, and the other one will run off, and we are always, as much as it is not a great outcome, or we'd rather give people their capital back than deploy it on a basis that makes no sense to us. And in part, that relates back to the alignment where we are the largest LP in our own funds. So we ended up deploying somewhere between 30% to 50% of the capital in those funds.
Yeah, I mean, the only thing I would add is clearly we wanted to deploy all the capital, but when we saw the market getting away from us, we were 30% of the equity ourselves, and there's that alignment. We went to the investors and said, we don't see this opportunity. We'd like to give you your money back that's not deployed, and in fact, we're not going to charge you the fees.
As we're looking for managers, that type of outcome is certainly one that we're looking for, as opposed to those managers that do just continue to plow the money into the market. So this was an outcome that, particularly on the timber side, that was a great outcome. The ag fund has been a little bit impacted by currency valuations and things like that, but we would certainly rather see this type of behavior as opposed to stretching for returns.
Well, that's what happened. But with the $100 million commitment now, do you think you've got that? You got that committed? Do you think you're going to use it?
Yeah, we've had no issues deploying capital in our core infrastructure funds. This is our 4th fund. And the pace of, we're not projecting a pace of deployment accelerating for this fund. We're projecting a pace of deployment very consistent with where we've been really since about the middle of our 2nd fund. And so we see no issues in deploying the capital in infrastructure. And the investable universe in infrastructure continues to grow tremendously. Governments privatize assets. Governments need new assets built, and strategics that own infrastructure that's non-core to their main business continue to bring assets to market. So we see a good investable universe and see no issues deploying the capital.
Thank you, Ben.
Thank you. Any other questions? Seeing none, I believe we might be ready for a motion. Linda.
Based on the recommendations of the Investment Committee, Real Estate Advisor Townsend, SIC staff, and the General Fiduciary Oversight of RDK, I move that the State Investment Council approve up to a $100 million commitment to Brookfield Infrastructure Fund 4 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate.
Second.
Any discussion? All those in favor signify by saying aye.
Aye.
Any opposed? Any abstained? The motion carries. Thank you, gentlemen.
Thank you very much. Thank you.
Oh. All right, we are on item 3E, Berkshire.
Yes. This is a little bit unusual. So Berkshire is they're a very well-known multifamily investment manager. We're in 3 of their funds. They have value-added strategies that have performed very, very well for us, and we like the team. But this is a little bit unusual. They launched this core fund, and the notion was that the core fund was going to get to scale. It would grow. They'd raise $500 million a year, and it would be a $1 billion, $2 billion, $3 billion portfolio of multifamily assets. And for a variety of reasons, that just hasn't happened. So a number of the investors in the fund are sort of saying, well, what's going on, frankly? And so there's a movement afoot amongst us and some of the Townsend clients and some of the other investors to basically redeem. And what that's going to mean is purchaser's going to be in a spot where they're going to have to decide, do they just want to liquidate the fund? Do they want to try to sell the portfolio to a single buyer? We haven't exercised, at least since I've been here in 3 years, we haven't exercised a redemption option. So it's a little bit unusual from that perspective, but unless this can get to scale, we just don't think it's a valuable thing to have in our portfolio. So our recommendation is we exercise our redemption option, and then as the proceeds are returned, which could take some time, then we'll redeploy, because we do like the multifamily space, but we just think there's some other options there that will give us a much more broadly diversified portfolio that has real scale, that can attract and retain the top talent. So that's really the nuts and bolts of this pretty simple recommendation.
Any questions? All right, seeing none, do we have a motion? Recognize Linda.
Based on the recommendations of the Council Investment Committee, Real Estate Advisor Townsend, SIC staff, and the General Fiduciary Oversight of RBK, I move that the State Investment Council approve full redemption from the Berkshire Multifamily Income Guarantee Fund as reviewed and discussed today by Council.
Second.
We have a second. Do we have any discussion on the motion? Seeing none, all those in favor?
Aye.
Aye. Any opposed? Any abstaining? Motion carries.
Thank you very much. Thank you.
Thank you.
Okay. Last one is item 3F. So the pavilion contract renewal. Welcome back.
Thank you.
Go ahead.
So on page 616 starts our memo. It's about a 6-page memo. It talks about the rationale for anything. If I could just summarize that for everybody that hasn't memorized the packet yet. Sun Mountain's roles currently are management of the 5 co-investment funds. That's about $192 million in commitments. Advisor to the New Mexico program. They do the distributed private asset services for us, and they also manage the New Mexico catalog. Pavilion's roles at this time are advisor to the National Private Equity Program. They do quarterly monitoring and reporting services for the New Mexico co-investment funds, and they're an advisor to the SIC Real Return Portfolio, which is mainly upstream or E&P energy investments. For perspective, it's about $2.3 billion in the National PE program and about $400 million in the Real Return. And just to be clear, the quarterly monitoring and reporting, they do not do due diligence or on the co-investment funds at all, or recommendations. The staff is recommending the renewal of the 4-year Pavilion contract that expires next month with the typical 30-day out, and also inclusion of the advisory duties for the New Mexico program as part of the Pavilion contract. The why in all of this is we are interested in always following best practices, and we would like to have some consistency across the portfolio and how we implement them. Staff and consultant currently work together to develop goals, strategies, and objectives for the program. We try to select the best managers, and we have to monitor the portfolio. Sun Mountain Capital is a general partner or manager for us, which means that we pay them management fees and carry. And the SIC doesn't typically utilize advisors in other asset classes that we are also using as a general partner due to a potential for a conflict of interest. We feel like Pavilion is the best choice to assume these duties. I think most people on the council are familiar with their excellent work on the National Private Equity Program since 2011. Pavilion has extensive experience in advising or managing state private equity programs, and they have an overall familiarity already with the current regional fund manager universe. And as part of this whole process, as found in the memo, we have negotiated a discount off of what we're currently paying for the mandate for both. And with that, I'll take any questions.
Are there any questions?
And if you have any questions for Pavilion, they're also here.
Yeah, I have a suggestion, just that given that we've already talked about in the meeting, making sure that we're doing productive comparisons and cross comparisons about investments in state, providing capital for state investments, state businesses. I'd like to push the envelope a bit here, unless there's disagreement from the council, to get more ideas from Pavilion and strategies about doing more in New Mexico. Certainly making sure that we have the data to understand what the potential risks are, back to Senator Rossin, so that we're clear about what expected and reasonable losses can be, and what we ought to expect in terms of growing and diversifying New Mexico's economy by providing more access to capital and these kinds of investments, which gives us better opportunities for the future. So if we can have Pavilion at the next meeting talk to us about some ideas and strategies, and I would assume that we'll also have those comparisons, Steve, so it should give us a productive baseline to have a conversation. Can we do that? Is there any objection from the council? Okay. All right. I think we're ready for a motion.
Based upon the recommendation of the Council Investment Committee, RVK and SIC staff, I move that the State Investment Council approve the proposed contract renewal expansion for private equity advisor Pavilion under the terms and conditions memorialized and discussed by the council today.
Second.
We have a second. Do we have any discussion on the motion? Seeing none. All those in favor?
Aye.
Any opposed? Any abstentions? Seeing none, the motion carries. Thank you very much, Mr. Lee. All right.
Madam Chair, just kind of following off of your request of Pavilion, on page 620, there's a description of how they help the Utah Capital Investment Corporation with a similar strategy, I think, that you're recommending, and so I was just wondering if maybe we could also have a highlight of that program they do with Utah.
I think that's a good idea. Steve says yes, Pavilion says yes. Thank you for highlighting that. Anybody else have anything else that ought to be highlighted based on the materials that you were reviewing today? Thank you very much. I appreciate that. Okay. Thank you. All right, we are now on item 4, CFO report. Yes, sir.
Yes, Governor, and I will be brief because I know we've been here a long time. As I do every month, I have included the budget to actual as well as an investment holdings report. We just are in the process of completing processing of the invoices for the 32 mandates that run through our budget. As the market has continued to improve, and we hope that continues, I will probably be revising up some of my estimates to get us through the end of the year, but I think we'll be in good shape as far as our budget is concerned. I did also note on item number 5 regarding House Bill 2 about the recommendation that was made. I think we're going to be well suited or well served with the appropriation that we're planning on, and I will have, and I plan on having this in not next month, but April. We'll have a budget for the council to approve for fiscal year 20. And then lastly, I did want to mention, because it's on item number 4 for the New Mexico Small Business Investment Corporation, we did top off their 1% investment in January. If you thumb over and look up the investment holdings report, because they report on a 1-month lag, you will not be seeing that additional investment until the next investment holdings report for February. Other than that, I'm happy to answer any questions. As I've said all along, if any of you have any questions after you get home, just feel free to call and let me know. I'm happy to answer questions at any time. That's all I have.
We've got a question. Thank you. Peter?
You know how much I focus on the SBIC, my favorite entity, and I appreciate what they've done. I appreciate that they've changed that focus over the years to debt, and they're doing well. They're out of equity, which was a disaster for them. And partly replaced that with the Catalyst Fund, so I think that's really good. I have a technical question that maybe you can research and come back to me personally or the council. I looked at their audited financial statement, and they show the contribution from us as revenue. Now, I would never have considered our funding of them as a revenue item from an accounting standpoint, but I'm so far away from accounting anymore, I may be wrong, but I don't know. That's our money. They're in effect borrowing and having a commitment to return. I don't know why that's a revenue item on their financial statement.
Peter, let me look into that.
Yeah.
And I'll get you a read on
it's
it.
just a very interesting reporting because it's a strange, Lee, it's strange, isn't it? We give that money and they report it as if it's income. And I don't know what happens when you roll it all up again for your financial report for the state as well. Scott.
For Brent, as we've developed our budget every year, we've always struggled with getting the right line item budget for the fees we pay for our various. Do we think that issue is going to resolve itself in the 1920 budget? Is it just going to drag on till the end of time?
I think we're doing better, Scott, as far as the fees are concerned. I think as I've gone and presented to the various committees, I think they're getting more comfortable with the way we're doing it, and I think we're going to be fine. Probably a bigger concern for me going forward is just staffing. I think we sought 5 positions being funded. We'll end up with 3. It's a start. I mean, we did kind of take a step back in this fiscal year, but going forward, I think we'll be fine. I just hope as we, plan for fiscal year 21 and beyond that we continue to have people that are open-minded. I mean, you have to spend money to make money, and that's really the key. And I think Vince has written various articles and documented various things as far as fees, and we'll continue to do that. And if we have questions, we'll try to address them the best we can.
Thank you.
So, Brent, if we can also, and thank you for that question, Scott, make sure that the accounting question that you raised, and maybe Secretary, you can take a look at that too, and make sure that we're accounting for that right and reporting it correctly so that everybody here is clear, primarily the chair.
Yeah, I don't want to take a lot of time. It's really trivial. It's $1 million.
But we just want to know. We want to make sure we're doing it right.
We can talk about it.
To the question, Governor, I'm happy to include everybody in on that, and give me a week and I'll have an answer for you.
That's plenty of time. Are there any other questions about the CFO report? All right, thank you very much. All right, we are now on item 5, closing matters, and we're going to get a legislative update
from Charlie. So, Madam Chair, members of the council, page 653 in Diligent, that's also in front of you, this two-sider here. This lists all of the legislation that we're currently tracking. We've highlighted a few bills, and those I think I would categorize as bills that directly impact one permanent fund or another and have some momentum, at least as we perceive currently. HCR 1, as you know, that's the bill to take an additional 1% out of land grant fund. It has passed the House and has 2 Senate referrals. House Bill 289 is a bill that would take, would actually require the council to invest another 1% in a broadly defined renewable energy portfolio. That one has also passed the House and Senate. House Bill 393, this is the Tax Stabilization Reserve Bill. It has its first hearing this afternoon in front of House Appropriations about an hour from now. It has one referral, so we think that one is probably going to move pretty quickly. Senate Bill 10 is a bill to double the size of the Small Business Investment Corp allocation out of the severance tax fund. It's about another $50 million. This is a governor-backed bill, and it flew through the Senate, and it's now awaiting its referrals in the House. SB 30 would take 0.25% of the severance tax fund, about $12 million, dedicated to early stage startups out of the universities, as well as the national labs. Those investments would be selected by the Technology Research Collaborative and approved by the council. And then Senate Bill 535, this bill we like. We aren't taking a formal position, but it would dedicate new dollars every year over the next 10 years, about $24 million per year before you even get to the formula. So we would not be saying, well, this year we only got $37 again. It helps stabilize the fund. It also flew through the Senate and is now over on the House side. I'm glad to take any questions about any of these bills or any other bills that you might have interest in, but that's your call.
Any discussion about the legislative update from the committee? Perfect. All right. So 5B, the next meeting is scheduled for Tuesday, March 26th at 9 o'clock in this room. And as Peter told me, the coffee is better. We'll continue to see what we can. We're trying to keep it hot now. Baby steps. The camera will work, so we will be able to webcast this entire meeting instead of just provide the audio and just make sure that everyone's here. There's no change in policy. We are clear that we should provide every possible access point to the public, and no good explanation about why we have not met whatever technical challenges appear to be plaguing us for the first two meetings, but they will absolutely and unequivocally get addressed. And we are, yes, Tim.
Madam Governor, this administration will continue the policy of discriminating against people who don't drink coffee. Certainly you would bring at least water or something.
There's water.
I mean, you get, well, not much. I mean, you drink a lot of water. People drink coffee all day long. But make 2 or 3 trips.
Fair enough. Any committee member, like Senator Tim Jennings, who requests particular beverages or snacks, I'll make sure that the Chief of Staff, John Bingaman, personally attends to all of those requests to make sure that it's being privately supported, and we will get that done. It's a trick question, Senator. All right. We are now we're not adjourning. We're now at the public comment period for the meeting. Do we have any public comment? Yes, sir.
Thank you, Governor, and members of the committee. The last meeting I mentioned opportunity zones, and I know you're well versed because you were there during the legislative process of it when you're at Congress. It has not finalized the procedurals because of the shutdown of the government, but it will be done. But I think that this body should really look closely at how they can participate with other funds that are raising money for opportunity zones. As of InvestNewMexico.us is now a qualified opportunity fund. As of yesterday, we saved a company in an opportunity zone with 25 employees that was set to go to auction on March 7th. We will retain the business that they're doing. They make tanks, and we're going to take those skills and we're going to expand another 50 jobs building shipping container homes and products. So, these are the opportunities that you have that will be coming up on the opportunity zones. Unfortunately, I didn't agree completely with the zones that were listed, but being from Las Vegas, New Mexico, and not being in that opportunity zone, but we're working to trying to create a business. Met with the SEC-US organization last week. It was packed. The hemp business is a business that a lot of people are looking. What do they lack? They have water, they got land, they got the skills, they lack working capital. So hopefully Opportunity Zone will give that. I kind of looked at my calendar and figured I've spent probably over 100 hours at these meetings. Given 3 minutes, I probably spoke 60 minutes. At the end of the meeting, like my wife says, don't say anything to me before bed because I'll forget about it. So it's the end of the meeting, so it probably was forgotten. But I hope you don't forget investing in the community businesses that really need it. We are at a point. We have a huge budget. Well, not a huge budget. We have a large budget compared to historically. Anytime anybody tells me, say we have a large budget, I said, yeah, we have $7 million. They spend $42 million in prisons in California, so we don't have a large budget. But the State Investment Council has been very successful. But it's very difficult to listen to $100 million here, $50 million there, and then go out to the community and find a business that says, I said, what do you need to plow that field? You need $10,000. Now with the opportunity in that whole market, and one of the things that we fought with in the rules is that the funds are not just going to be regulated to only take the funds from those tax payers who have the capital gains, and so it'll be open, and hopefully that'll be clarified. But the other thing we're seeing a lot is the large hedge funds are now activating opportunity funds to invest in real estate. Those real estate investments you just made, there's going to be huge competition because you're talking about $2.9 trillion in capital gain money that's going to flow into that fund, and there's going to be a lot of competition. But that's what I have to say. Thank you.
Just a minute, everyone. I really appreciate very much that you are here, that you stay the whole meeting, and unlike at my age when at the end of the day you can't remember anything, we have a record of that, and it's exactly the information and the conversation. We do want to figure out productive, smart, reasonable strategies that get to rural New Mexico businesses, not in lieu of any other businesses, but really think about helping our businesses thrive and to create the kind of diversification, particularly in value-added ag. Not that hemp in and of itself is that, but there are lots of ideas and potential investment opportunities. The opportunity zones, I just spoke with the small business administrator in Washington. They are looking for states to take leadership positions as they develop their own strategies. They're also, I think, in the next year going to take up some renewed, well, I don't want to jinx it, investment and effort in infrastructure, and see if they can't come with some proposals that can get through both chambers that would not hurt local bodies of government and not overly burden states as we try to figure out what that partnership would look like. So I do think that this is a timely statement, and you should expect to have us have more conversations about what makes sense. So I appreciate you very much for being here.
Thank you.
Mr. Jennings.
Can these opportunity zones be used as means for New Mexico to market some of New Mexico's natural resources?
Senator Jennings, to that point, I don't believe that is a restriction. It really depends on both the industry and the region. But I should take a look because I can't answer that without looking at it more carefully. Does anybody know the answer to that specifically?
Governor, tourism is one area that is one of the top areas that is applicable for investment. So, like we've looked at, for example, Meow Wolf opening up a facility in Gallup where there's an opportunity zone and making it, that tourism.
But I don't think there's a prohibition. And so I'm getting some nodding by someone who appears to have read that more carefully than the chair. But I don't think there are any specific prohibitions. So as long as you meet sort of that you can demonstrate that you've got a zone where that particular industry is occurring, and then you've got an ability to import-export those efforts, it meets the basic criteria. So we should take a look again. I think it's we should be, this council And certainly my administration ought to be paying a great deal of attention to every matching and federal opportunity that we have to meet particularly emerging industries in rural New Mexico, no question. And I should do one more. And generating our core energy industries by looking at opportunities for them in the future. And I will tell you that while we may have disagreement as individuals, not as investors, that is a core issue for the White House currently, is figuring out ways to get energy products to market and get them out of states like ours and others. So it's something that we should be talking about, I think. That's just my opinion. Anything else? It looks like we have, I will entertain a motion to adjourn. Your favorite. Oh, Peter, somebody beat you to it. Do I have a second?
I'll second.
All right, Peter, you are ready to go. All those in favor? No one's abstaining or saying no. The meeting is now adjourned. We'll see you in a month.